Chair.
Yeah, got emails from friends who said the noise went up one side and down the other.
Welcome, everybody. On behalf of the Alberta Automobile Insurance Rate Board, I would like to welcome you to the Alberta Automobile Insurance Rate Board's 2015 Annual Review of Automobile Insurance Trends and Premiums related to basic and additional coverage for private passenger vehicles. Before I begin, I would like to highlight a few housekeeping items. In the unlikely event of an emergency, such as a fire alarm, an alarm will sound, and it may be also followed by a message. In an orderly fashion, we can proceed out these doors, and right to the right, there's an emergency exit, and you can follow the stairs up, out through the building. And the muster point is on the southwest parking lot, so you head west and then south on 104th. There we can wait for instructions from the building staff to see if we can return or what other instructions they have. We have scheduled this meeting to run for approximately, originally for 2 hours or to 2:45, but to accommodate some of the presenters' travel schedules, we're going to truncate our lunch hour to just a half hour, and therefore we'll start up again at 12:30 instead of 1 as per the schedule. So we should be done a little bit earlier, subject to the presentations and the questions that we may have. We will take a short 15-minute break following Oliver Wyman's presentation and are planning, again, that half-hour lunch. Washrooms are located just outside these doors. There are some codes that you need to enter them. Men's number is 37852. And women's is 25837. If you didn't get a chance to write that down, there is a small piece of paper attached to the wall that has those codes on them. And I would like to ask everyone to turn their cell phones on mute. That's particularly important for board members, as these mics are live throughout the meeting. Under the Insurance Act and the premium regulations, the Automobile Insurance Rate Board is required to conduct an annual review of automobile insurance trends and premiums related to basic coverage and additional coverage for private passenger vehicles. As part of this process, the board is holding this open meeting to hear from stakeholders. The purpose of today's meeting will be to receive input to assist the board in analyzing industry experiences in order to develop industry benchmarks for insurers and the board to use in the development and review of rate filings. According to legislation, the board must consider industry-wide loss costs, administrative expenses, profitability, and any other matters the board considers appropriate. The review will not address commercial coverage, complaints against insurance companies or the industry insurers. Presenters and presentations that stray into any matters beyond the mandate of the board review will be ruled out of order by the chair, and they will be asked to refocus their presentation. Only those parties registered to give a presentation will have an opportunity to speak to the board. There are copies of today's agenda along with our 2014 annual report available on the table if you're interested. Members of the public or other presenters will not be allowed to cross-examine presenters. Only members and representatives of the board may ask questions of the presenters during the meeting. This meeting forms one piece of a process through which the board will arrive at its industry benchmarks for rate filings that will be posted on the AIRB website prior to October 1st, 2015. This meeting is being recorded to allow the board to review the comments made by each presenter. Copies of today's presentation and the written presentations will be available on our website, which is www.airbalberta.ab.ca, following the meeting. In addition, we'll be uploading this recording of today's meeting prior to August 31st, 2015. That being said, I would like to start by asking each of the board members to introduce themselves at this time, starting with Chris.
Thank you, Alan. My name is Chris Daniel, and I'm the consumer representative for the board.
Charlene Butler.
Maureen Higgins.
Jim Murta.
James Cumming.
Mark Prefontaine.
Norbert Van Wyk.
And I'm Alan Claren. So thank you, everyone, for attending. I would now like to recognize the written submissions that the board received and will identify each for the record. The Cooperators Group Ltd., Alberta Civil Trial Lawyers Association, and Desjardins Insurance. Having completed agenda item number 1, we will now move on to agenda item 2 and ask Mr. Ted Zubalek, the AIRB's consulting actuary, to come forward to present his report, Review of Industry Experience. This report was presented to the AIRB website, or posted to the AIRB website on June 29th for review and comment by stakeholders at today's meeting. Welcome, Mr. Zubalek.
Thank you. Prefer to sit here just in case there is an emergency. I'm the one closest to the door.
That's how you'll hold the door open for us.
Oh, right. For those of you who've been to prior meetings, you know I've always struggled with this little gadget. Hopefully I can do a better job this time. Good morning. As the chair mentioned, this is the second annual industry review. The board has also conducted a less formal semi-annual review 6 months ago. And the purpose of these reviews is to provide the board with information to help it set benchmarks that will apply to rate filings submitted to the board. And in this case, those rate filings submitted to the board between October 1st, 2015 and March 31st, 2016. And the benchmarks are also used to help estimate the rate level needs of the grid. The board will be making a decision on the grid rates also shortly. The review also helps the board to better understand what is happening with auto insurance in Alberta. As respects the benchmarks, we, Oliver Wyman, as the board's consulting actuary, have provided the board with a report that includes our preliminary recommendations as to what we believe the benchmarks should be. Our report was publicly released for reaction and comment by interested parties, either through the form of written submissions and/or oral presentations at this meeting today. Following this meeting, we will consider the information that was presented and prepare a final report to the board with our final recommendations. The board will then make its decision on what the benchmarks should be. As respects the Alberta automobile insurance environment, in our report to the board, we present some high-level statistics that we compiled from information published by GISA, the General Insurance Statistical Agency. The statistics we present are for all insurers in aggregate in total, and so they represent a picture of what is happening in the province on average. But as an average, the picture does not represent what is happening to each and every insurer. It is for this reason that the board is also interested in hearing from individual insurers, IBC, and FA, who can provide greater insight into the Alberta insurance environment. Let me begin with some information about the Alberta environment. Just first, just a simple picture of the breakdown of premium and claim costs among the coverages. You can see from this chart that the basic coverage on a written premium basis makes up just over 50% of the total written private passenger premium. The numbers in parentheses are the ones that we had reported last year. So you see that there's been some modest changes. And the claim costs, so while basic coverage represents just over 50% of the premium, it's close to the 60% of the claim costs, at least the claim costs as estimated by Oliver Wyman. The breakdown of basic coverage claim costs per our estimates by sub-coverage. You can see bodily injury is the predominant coverage with about 60% of the, representing about 60% of the total basic coverage claim cost. This is for year 2014. Property damage about a third, and accident benefits a little bit less than 10%. And among the additional coverages, collision and comp obviously are the major coverages, almost close to 50% for both. The other more minor coverage represent 1% or less of the total claim costs, the specified perils, all perils, and the underinsured motorist coverage. So it's collision and comp that are the major coverages among the additional coverages. Just some economic statistics just quickly highlight the unemployment rate. You can see after hovering around 4.5% for the last couple of years, last 3 years, it's now jumped to 6% as of July of this year. The Alberta CPI, the total CPI, has risen just under 2%, about 1.7% since a year ago. Excluding energy, the CPI increase since the last year has been about closer to 2.5%. Gasoline prices, fluctuate every day, but as of these points in time, and relatively stable, a little bit lower this year than last year. Natural gas prices took a big drop since last year. Canadian bond rates, a big drop in the rate, 0.45% compared to just over 1% last year at this time. Number of insured cars increasing by 60,000 since last year, and population increasing by about 120,000, close, or a little bit more than that since last year. And you can see just graphically how the unemployment rate is fared going back to pre-1980, and how the investment rates have fared since, I guess, year 2000. We show going back to 2000. So we're at the low point. And those of us that save money in savings accounts know that we're not getting very much of a return. All right, let's talk about the benchmarks, and I'll begin with loss development factors, and later we'll cover loss trend rates, what we refer to as the ULA provision, catastrophe loading, investment rate, the health cost recovery, operating expenses, and profit. As respects the loss development factors, as I've explained in past meetings, including past IWA meetings, insurers report to GISA 2 pieces of information on each and every claim that they have. One is the amount that they have paid on those claims, on each claim, and second is the amount they think they will still need to pay out on each claim, which we refer to as the case reserve or the individual claim reserve. For various reasons, in aggregate, the case reserves that are set tend to be less than what is ultimately paid out by insurers. And for this reason, insurers also establish what I refer to in our report, and I will do so here at the meeting today, as the actuarial reserve, which it's also referred to as an IBNR reserve or a bulk reserve. This actuarial reserve is intended to provide for the shortfall that may exist in the case reserves, and it also provides for claims or accounts for claims that occurred but had not yet been reported to insurers as of the time of the evaluation. So combining the actuarial reserve with the amounts that have been paid and the case reserves provides a more accurate picture of what an insurer's claim costs are. However, the actuarial reserves that are established by insurers are not reported to GISA. Insurers report their actuarial reserves in their financial statements, but not to GISA. So we, Oliver Wyman, estimate what we believe the actual reserve need is for the industry in total. And we do this by coverage and by accident year. And by accident year, I mean it's a way of categorizing the claims based on the year in which the accident that gives rise to the claim occurred. We derive the actuarial reserve estimate for the industry based on actuarial techniques that we apply, which in turn are based on the amounts that have been paid and the case reserves that are carried as reported to GISA. We then convert the actuarial reserve into multiplicative factors that can be applied to the total of the payments made and the case reserves carried, and it's these factors are what we refer to as the loss development factors. We also derive factors for claim counts based on our analysis to estimate the number of claims that will ultimately be reported to insurers. These loss amount factors, or more precisely, the ultimate claim cost estimates that we derive, are then used to measure the change or trend in industry claim costs over time, information that serves as the basis for the recommended industry benchmark trend rates. It's important to note that our estimates of industry claim costs change over time, and we've commented on this at prior meetings. As time passes, more claims are closed, and those that do close, and as they close, payments are made on those claims, and those payments replace the case reserves that are carried. Also, as time goes by, the case reserves are refined. As time passes, more information about individual claims becomes known to the companies, and the case reserves are adjusted to be at a more accurate level. And as the case reserves are adjusted to be more accurate, there is less of a need for the actuarial reserve, so the actuarial reserve tends to come down over time. Every year, I have presented our updated claim cost estimates based on our review of the data published by GISA. For this particular industry-wide review or industry review, we considered the industry data valued as of December 31st, 2014. For last year's review, we considered the data published by GISA as of 12/31/13. And for the last semi-annual review, again, the less formal review, we considered the industry data really as of June 30th, 2014. So as compared to the information we had a year ago, insurers have made payments made payments on claims that were reported and open as of 12/31/13 over the past 12 months. They have adjusted their case reserves on claims that were open as of the end of 2013 that are still open as of the end of 2014. And we now have a new set of claims to consider. These are the claims that occurred in 2014. So let's see how our estimates have changed, and I'll just focus, since last year, and I will focus on the bodily injury coverage. This chart shows our estimates, or depicts our estimates of the industry ultimate claim costs by accident year, spanning the years 2009 through 2014, and how the numbers have changed. The rightmost bar in each grouping represents our current estimate of, by the height of the bar, our current estimate of the claim cost, the industry claim cost for the bodily injury coverage. To the immediate left of the rightmost bar within each grouping, that bar represents our estimate of the ultimate claim cost as of the time of the 2014 or 15 semi-annual review, so based on the data through 6/30/14. To the immediate left of that bar would be our depiction of our ultimate claim cost estimate as of the time of the last year's the 2014 annual review, again based on data as of 12/31/2013. And to the immediate left, where there is a fourth bar, the height of that bar represents our estimate of the ultimate claim costs for the industry, for the bodily injury coverage at the time of the 2013 IWA, based on data valued as of December 31st, 2014. So again, the height of the bar depicts our respective claim cost estimates as of that point in time for the bodily injury coverage. Within each bar, the dark blue portion represents the amounts in millions of the dollars that the companies of the insurers have actually paid as of that point in time. So for 2013 accident year, as of 6 months ago, $52 million has been paid, and as of the end of 2014, $92 million has been paid out on claims. The gray color represents the amount of case reserves carried by the insurers in the province for private passenger automobile bodily injury coverage in aggregate. So again, looking at the 2013 year, looking back 6 months, $312 million was carried in aggregate on case reserves. That number is now $299 million. And the light blue represents the actuarial reserve estimate. Again, 6 months ago, we had estimated a need of an actual reserve need of $324 million. We've now reduced that to $264 million. So the sum of all three pieces, the components, the payments, the case reserves, the actuarial reserve, again, represents, if you will, an estimate of the total claim cost that will ultimately be paid when all claims are ultimately settled. As can be seen by the chart, we have, up until this year, been increasing our estimates. And if we were to go back another 6 months or another 12 months prior to these numbers, you'd see that the increase, we have been increasing our estimates for a number of years. And again, we reported this at last year's industry review public meeting, which means in hindsight, after considering the new information that becomes available, we realized that our prior estimates were simply too low. That was the case again so you can see how, again, the height of the bars in each accident year had increased over the last 3 reviews. Until now, for this review, based on the information, again, published by GISA and the analysis we performed, we have lowered our estimate just about for every year. As you can see, what actuaries refer to as development, that the losses, in our view, didn't develop as much, which means the payments that were made since last year and the changes in the case reserve since last year weren't as great as we thought they might be. And as a result, we have lowered our estimate of the ultimate claim cost for each of the last few accident years. Now, I want to be quick to point out that this doesn't mean that all of a sudden the bodily injury coverage has become profitable. By no means do I mean to suggest that. These numbers, if you combine them with the operating expenses reported by companies and consider the investment income earned by companies and the premium collected, the bodily injury coverage is still quite unprofitable, has been unprofitable for the industry. What our lowering our estimates means is just not as bad, not quite as bad as we thought was the case six months ago. But again, these are not by any means profitable numbers. It's also important to note that our estimate, again, this is a very green estimate, it's our first look at the 2014 year. It's quite immature. Very few claims are closed. Not all the claims have been reported yet, but our current estimate of the 2014 year is higher than any prior year. And in our report, we present to the board the loss amount factors that correspond to each of these, to our 2014, to the rightmost bar, estimates for each of the rightmost bars. And we provide similar information, not quite as detailed, for the other coverages in our report. I think it's fair to say that no party that submitted a written response took issue with the loss amount factors that we're recommending to the board, although FA suggested that we could apply other actuarial techniques to perhaps get a better estimates of what these ultimate claim costs will be, and we moved somewhat in that direction in this last report, and we will continue to look at other methods going forward. We also convert, so that's kind of the picture on loss amount factors. Again, our recommendations are on a report, and no major objections to what we have recommended. We convert our estimates of the number of claims that will ultimately be reported and the dollars of losses that, or claim costs that insurers will ultimately pay out into what we refer to as frequency, severity, and loss cost statistics. And these statistics are used to help to observe and measure and recommend trend benchmark rates. Frequency, or claim frequency, is simply the number of claims, the estimated number of claims that will be reported, divided by the number of insured vehicles. So it's the claim incident rate, claims per insured vehicle. The severity, or the average cost per claim, is simply our estimate of the dollars of losses that will be ultimately paid out relative to the number of claims that we estimate will be reported, again, the average cost per claim. And loss cost is the product of frequency and severity. It's the dollars of, estimated dollars of claim costs as a percentage of the, or per insured vehicle. Again, frequent loss cost is the equivalent to the product of the frequency rate, the incident rate, and the average cost per claim. So let's now look at our recommended, or let's at least discuss trends. And I'll begin by doing so graphically. Again, these are all estimates, and we've talked about this at length at many of our meetings and in our report as well. But these are estimates. The numbers I'll be presenting to you are estimates. Different actuaries will have different estimates of what the claim counts will be by accident year, or what the ultimate cost will be by accident year. We won't know for certain until all claims are reported and every single reported claim is closed. And for the bodily injury coverage, that's going to be quite a number of years. So these are estimates, and the estimates, as I noted earlier, change over time. On these graphs that I'm about to show, beginning with this one, we show three lines. We show what our estimate was of again, this would be the claim frequency rate by accident year, going back to the 2004 annual review. So this would have been based on data as of December 31st, 2013. We show by the gray line what our estimate, again, claim frequency rates and later severities and loss costs were at the time of last year's semi-annual review based on data through June 30th, 2014. And the green line depicts our current estimates based on the GISA information published as of 12/31/2014. And you can see that two things that this particular graph shows. Number one, that our frequency estimates haven't changed all that much. Pretty much we get a good handle on the number of claims that will be reported, although for bodily injury, it just takes a little bit of time for all claims to come in. But secondly, you'll see that the claim frequency rate after a period of decline, of a few years of decline, and we talked about that decline, that got a lot of attention a few years ago at those industry-wide meetings, the cause of the decline and whether or not it would continue. But it has, as you can see, flattened out over the last few years. Severity, different story. Again, you'll see the three lines, and you can see what we thought the average cost per claim by accident was a year ago, as depicted by the blue line, how our estimates increased when we looked at the numbers again as of June of 2014. Again, I commented on this earlier. And how you see our estimates have changed yet again based on information through 2014, as depicted by the green line. It shows, again, some variability. Again, this is around the time of the 2004 reforms that contributed to a decline in the average cost per claim. But since that time, the severity, the average cost per claim has been increasing, some variability, a little bit of a dip around 2009, a sharp increase the second half of 2010, and you can see how the severities have, again, these are our estimates of the severities, have been changing over the last couple of years. And the loss cost graph, again, the product of frequency and severity, the combination of the two, is depicted on this chart. Based on this information, based on our analysis, and we'll talk about comments we received from other interested parties in a few moments, we're recommending to the board a benchmark trend rate for bodily injury coverage of 4.5% a year, which is an increase over where we were 6 months ago of 2% a year. We just feel you can see that by that 4.5% growth rate is depicted by that the dotted red line, and you can see it kind of hover close to the actual data points that we estimate for those years. The other part about the bodily injury coverage is that, as I quickly commented on earlier, we observed a sudden and sharp increase in the bodily injury severity primarily, and it filters into the loss costs, around the second half of 2011. We referred to that as a level change. I think some of the stakeholders, or one of the stakeholders referred to it as a bump. But it was a fairly sharp increase, but based on our analysis, that occurred the second half of 2011, and we call that a level change, and we estimate that level change to be, I think in our report we said plus 10%. We had 6 months ago, when we first looked at that and observed it, recommended or calculated a level change of plus 20%. Based on the new information, we've lowered that estimate to 10%. This is an important number also for companies to use, or to consider at least, in their rate filing analyses, or their analyses of the rate level needs. It's an adjustment that companies would make if they agree that indeed there's been a bump up in their historical numbers to project forward of what the claim costs will be for the rate for the year for which they're projecting they will need, their rates will take effect. Again, I will come back to this a little bit later when we talk about the comments from the other stakeholders, but again, I just want to point out there are two components to the bodily injury trend: this level change factor of 10% that we're recommending, and the annual trend rate of loss cost trend rate of 4.5% a year. I'll just more quickly run through the graphs, similar graphs for the other coverages, the major coverages. Property damage frequency, you can see how, again, our estimates haven't really changed all that much over the last 3 cycles or 3 reviews. and that its frequency is relatively flat, at least our estimate of the property damage frequency. Severity has been increasing, again a bit of a flattening during this period, but since then, since 2011, so a fairly steady increase in the average cost per claim, and the loss cost is right here. And again, we had recommended a benchmark in the semi-annual review of 3%, benchmark trend of 3%, and we continue to recommend a 3% trend rate for the property damage coverage. Medical payments, it's again a component of the accident benefits coverage. Again, relatively flat frequency over the recent past. Again, the claim incident rate. Severity, a little bit more volatile. Again, a dip back here. Fairly steady increases, a small a leveling, and again, it's early yet, but an apparent leveling off of the average severity beginning in 2013 into 2014. We don't have quite a nice fit here as depicted by the dotted red line, but we are recommending a medical cost trend rate of 2%, slightly lower than the 2.5% we had recommended 6 months ago. Again, I guess you could make a case that maybe the trend is even less than that based on what's happened over the last couple of years. We just don't think there's enough information yet to conclusively or say that the trend is flattening significantly. So we modestly reduced the trend by 0.5 point. Disability income, a fairly minor coverage. You can see the frequency rate. We hardly changed our estimates over the last 3 reviews. Again, a fairly flat frequency rate following the decline through 2010. The average cost per claim was much more volatile than we see in the other coverages, an up and down kind of movement, and the loss cost picture looks like this. We are recommending a 2.5%, negative 2.5% trend rate on the disability income coverage. IBC had commented on this, and as did one other insurer, and we'll talk about that in a moment. But our recommended trend rate is negative 2.5%. Collision, you can see frequency pattern, kind of some up and downward movement the last couple of years. Claim severity looks a little bit like the property damage severity pattern. After a flattening, leveling off in these years, it's starting to pick up again. And you can see the loss cost pattern, and we are recommending a 5% trend rate for the collision coverage. This is a fairly significant increase over where we were 6 months ago. I think 6 months ago we were a little bit reluctant to raise the recommended trend rate off where we were prior to that point in time. But with the new information, we feel that a 5% trend rate is warranted. Now, comprehensive. These are our estimates of the actual frequency. You can see up and down, severity, and loss cost, and up and down movement. Comprehensive, as we've discussed at prior meetings, is heavily influenced by the occurrence or non-occurrence of catastrophic losses. We have not yet settled in on a recommended trend rate for the comprehensive coverage. What we prefer to do is pull out of this information the catastrophic losses that are reported to GISA, select a trend rate excluding the catastrophe losses, and then provide for the catastrophic losses through a so-called catastrophe factor that we'll be talking about in a moment. Unfortunately, GISA has not yet released the catastrophe data that we need for 2014 to make these adjustments. I believe that data is expected any day now, and when it does come out, we'll do our analysis and include our recommended trend rate to the board in our final report. So our summary of our trend rates is as follows. This is where we were at the 2015 semi-annual review. Here's where we are now, again with the caveat that we haven't yet completed our analysis of the comprehensive coverage. Comments from interested parties. I'll just quickly, IBC, and I'll just focus on trend right now, but excuse me, one second. I just want to make before we get into the industry comments, I'm going to just make one other comment, which I neglected to mention earlier, and I should have. Our claim costs, those graphs that I showed, the claim costs, there are three components to the claim costs on those graphs. There's what's referred to as the indemnity portion, the amount that's actually paid to the claimant, what's referred to as the allocated loss adjustment expense, or the ALAE component, and those are the claim settlement costs that insurers incur that can be directly associated or directly allocated to individual claims. Legal expenses, for example, an insurer hires an outside attorney to help defend a particular claim, and that attorney's claim cost can be assigned to that claim. So there's a direct allocation or alignment of legal expenses to claims. But there's also a third component to the numbers that I presented, the graphs that I presented, called the unallocated loss adjustment expenses, or the ULAE. These are claim settlement-related expenses that cannot be directly attributed to particular claims. Overhead costs, I mean, the salaries of claim employees, or the rent cost to house the claim staff, whatever. FA has raised concerns about our consideration of the three components for purposes of selecting trend rates. First, FA states that it's more accurate to separately analyze the indemnity costs and the ALAE costs. They develop differently, they trend differently, and I would agree with that. But the fact is that insurers, when they perform their analysis and they present their rate filings and rate filing rationale to the board for approval, they combine ALE and indemnity costs, much as we have done here. So separating the two components would cause companies to change the way they perform their analysis of their rate level needs. I don't believe the board directly asked for comments on this particular issue from interested parties, but IBC did comment on this issue. They realized that we had noted this as an issue in our report, and they simply commented that they're fine with staying with the more traditional way of combining ALE and indemnity costs for purposes of measuring trend. The second issue raised by FA as respects the components has to do with the ULAE. FA pointed out that including the unallocated loss adjustment expense in the manner in which we do, which is based on factors that are published by GISA, distorts the claim cost trends. And this is because, again, as I said, ULAE costs can't be directly allocated to a particular claim, a particular accident year, particular coverage. And so any consideration of ULAE along with ALE and indemnity could distort the true underlying trends. The argument for including a provision for ULE is that claim costs or claim-related expenses can shift over time between ALE and ULE. And so, for example, if an insurer were to somehow incur more ULE costs than ALE costs, and then we remove ULAE, the decline in the ALE costs would appear as a decline in the trend, when in fact that would not be the case. It's just more of a reflection of the movement between ULE and ALE and vice versa. So there are problems either way you handle ULAE, including it or not including it. Again, issues either way. The board did pose that question to interested parties for comment and reaction, and IBC and the other insurers that responded to that all seem to be comfortable with continuing to include ULAE in the manner which we have. Again, recognizing there's some distortion, but also recognizing that perhaps to fail to do so, there'd be distortions as well. And I will only say that if the board decides that it wants us to remove ULAE or exclude ULE from our calculation of our trend or benchmark recommendations, that decision take effect beginning with the 2016 semi-annual review, as all the analysis has already been completed, including ULAE. So if the board wishes us to change and makes that decision, again, I suggest we begin with the next review. Okay, so back to comments. IBC generally, again, took no issue with our recommended trend rates, except in the case of disability income. IBC said in its written submission that due to the downturn in the economy and the higher unemployment rate and other things that are going on that we commented on earlier, their expectation is that the disability income costs will trend at a rate higher than our selected or recommended -2.5% annual trend. So either a lower negative trend, a flat trend, or no negative trend at all, or even a positive trend. We will consider that input or those comments from IBC as we prepare our final report. I don't know if we're going to change, but we'll take a look at that. As respects that level change of plus 10% that we are recommending the board accept, IBC's actuary, Dr. Ron Miller, suggests that, or based on his analysis, a level change of 11.3% would be more appropriate, comprised of a severity adjustment of, he observed a 16% increase in severity in the second half of 2011, and frequency declining by 4%. Combining the two, he arrives at 11.3% indicated level change, and he believes that's a little bit more reasonable than our 10% change or level change. We will consider Dr. Miller's comments, although I note that the difference between the 10 and 11.3% in the way this factor is used isn't all that material, but we will take it under consideration. Some insurers report or believe, per IBC, that a level change occurred at that time closer to 20%, and even that factor is more appropriate. The board will have to, companies are expected to provide their own experience when they submit their rate filings, and if they truly believe that a higher adjustment is appropriate, I'm sure the board will consider that. TD, I don't think directly commented on the trend rates, but they'll be presenting later today, but they did report some of their own statistics and they find that the bodily injury costs are increasing at a rate of a little bit higher than the 4.5% trend rate that we are recommending, although I think they mentioned that while they noticed a bump or a level change also occurring around the second half of 2011, it wasn't as great. It was closer to 5% than our 10%. So you can see different companies have different experience. I'm sure we'll hear about this later, but TD cites the McLean versus Palmer trial decision in early this year that may lead to a higher, further erosion of the bodily injury cap and lead to higher bodily injury costs. Again, they'll be commenting on that, I'm sure, later. Aviva says they find our trends reasonable, but acknowledges, and we agree, that there's a high level of uncertainty with the bodily injury claim costs and trends. They also commented on the McLean decision. I guess they'll be talking about it later today, and the Sparrowhawk decision as well, and how at least the Sparrowhawk decision may be contributing to higher claim costs that we're seeing for the bodily injury coverage. They also comment on the legal representation that claims seem to be representing, legal lawyers are getting more and more involved in representing claimants than they have in the past, and that's also contributing to higher bodily injury claim costs, and again, I'm sure they'll cover that when they speak today. Desjardins says they observed trends similar to those reported by Oliver Wyman, but they also find that the 10%, well, they find that the 10% adjustment that we're recommending is reasonable, but again, they comment on the high degree of uncertainty surrounding the bodily injury coverage. Cooperators, in their written submission, has said they're experiencing a rise in bodily injury severity both inside and outside the cap. They comment on the McLean decision. They also comment on the increases in physical damage or the additional coverage claim costs due to increases in repair labor rates and the unregulated towing and storage industry and the affinity for more expensive pickup trucks. I should point out that these, these claim cost trends that we're presenting here and showing, to some extent, are being caused by changes in the nature of the risk. For example, the bodily injury trend is to some extent, maybe it's a small extent, but to some extent is impacted by people purchasing higher and higher limits of coverage. I think on average over the last couple of years, the average bodily injury coverage limit has been increasing at 1.5% or so per year. So those increases in coverage provide insurers with more premium, and that premium offsets some of the increase in claim costs. And insurers, when they present their rate level needs, not only reflect claim cost trends, but they should also be reflecting trends in their average premium to, again, as an offset, at least a partial offset to those claim cost trends. The same goes with the additional coverages. As people buy more and more newer cars, those newer cars are more expensive. They contribute to that increase in average cost per claim, perhaps more expensive to repair, but at the same token, they cost more to insure, and insurers are collecting more premium for those newer vehicles, and that additional premium is also reflected by insurers in their rate calculation of their rate level needs. FA has taken issue with the manner in which we, Oliver Wyman, arrive at our trend selections, and the way we document or present the rationale behind our findings. And we accept their views, and we will consider their points that they've made in future reviews. We have, to some extent, considered their comments that they mentioned or they presented for the semi-annual review. And again, we will continue to look at and consider the points that they've made. FA provided some trend rates that they've calculated, and I present them in the chart here, but these are not directly comparable to our numbers. As I mentioned earlier, FA has the view that one should just look at indemnity only, and so their trend rates, I believe this is the case, that I posted here, or that I present here, are based on an analysis that they performed of the indemnity costs only, whereas, as I mentioned, our trends include or reflect the ALE and the ULE provisions. So they're not directly comparable, but nevertheless, with that caveat, the numbers aren't too far apart. Bodily injury, again, if I'm representing accurately the FA's position, coming out at 4.5% trend, identical to our trend. Property damage a little bit lower. By the way, the numbers in parentheses are the FA presented kind of a confidence level range around its estimate of trends. So all of our numbers, for bodily injury, for example, while their selection is 4.5%, I believe they're saying that a trend plus or minus 1.1 points off the 4.5 would be a reasonable trend as well. And all of our trends do fall within FA's range, again, subject to the caveat that we're not quite comparing apples and apples. The one coverage that we're off a little bit on accident benefits, we're a little bit higher. Collision, our trend is a couple points higher than FA's trend. And comprehensive, again, we haven't completed our analysis. So, except perhaps for the collision coverage, we're not too dissimilar from FA's trend, but again, the bases are somewhat different. And I mentioned these points. The ACTLA didn't comment directly on the trends, but they did comment that, or express some concerns or frustration that the industry doesn't publish information that shows detailed information about how claims within and outside the cap are being settled, or what is driving the increase in claims and BI severity, citing that no industry data has been reviewed to show how the caps are defined or the breakdown of claim costs between capped and non-capped claims and by head of damage. I have no comment on that. Again, this information is not reported to GISA. So that's the picture on trends. The ULA provision I covered. We accept the ULE factor that is published by GISA, which for 2014 was 9.3%, and for now it's it is 9.3%, and we're recommending that the benchmark ULE factor follow what GISA has published, the same 9.3% for 2014. The cat loading, the catastrophe loading, I mentioned earlier that our preference is to do an analysis of comprehensive coverage trends, excluding the catastrophic losses, and provide for catastrophic claims in the rate indication analysis through the use of a factor. Last year, for the year-end, for the 2013 or 2014 annual review, again, the review based on data through 2013, we had initially recommended to the board, based on our analysis of the industry catastrophe experience, a loading of 30%. There was some reaction to that during last year's public meeting. IBC in particular, and others as well, felt that the 30% was much too low. Thought that for various reasons that we should be focusing more on the industry catastrophe experience over the more recent past, as recent as over just the past 5 years, as opposed to a kind of a 25 or 30-year look that we had initially performed. And so after considering that, we came back to the board with a recommended catastrophe loading last year of 40%. That 40% has been in place ever since, and again, as we said, we're waiting now for the new catastrophe data to be published by GISA, and we'll take another look at the catastrophe factor and include that what we recommend to the board in our final report. Again, no one seems to. There's no argument over what what data should be considered or what the data is, but IBC and others think that we should be focusing just on the last 5 years of industry experience, which show the catastrophic losses to be a heavier component of the total comprehensive losses than catastrophic losses were prior to 5 years ago, and we'll consider that as well. Investment income rate. The board's position on investment income rate, again, the investment claim costs that are projected by insurers are to be offset by investment income they could earn on the premium that they collect based on risk-free yields. This has been the board's position for quite a few years now. When we prepared, at the time we prepared our preliminary report, we had the latest Government of Alberta's forecast of 2016 and 17 yields was these numbers in parentheses, that I have here. 0.95% for the 3-month yield for 2016, 1.6% for 2017, 2.65% for the 2016 year, the 10-year yield, and 3.4% for 2017 year, which the average duration, if you will, of a claim for all coverages combined is roughly 2 years or so and change. So we try to do some averaging of these are the only numbers, unfortunately, that are published by the Government of Alberta, a 3-month yield and a 10 years. So we kind of do a blending of the two to come up a yield that would be more appropriate for a 2.5 year claim duration. And based on that information at the time of our preliminary report, we had recommended a 1.5% average and risk-free investment rate. Well, IBC commented that they found that the 1.5% to be too high, although I don't think they provided their own particular specific number for us to consider. But since the release of our preliminary report, the Government of Alberta has come up with yet another revision to its interest yield, risk-free, or its bond yield forecast, 3-month and 10-year forecast, and has lowered its estimates to the numbers right here and here. So the 95 came at 0.55, 1.6 dropped to 1.4, 2.65 to 2.3, and the 3.4 to 3.1. And when we do our same kind of blending of these numbers to get something more appropriate to correspond to the duration of an average claim, we're now arriving at a number of 1.1%. So our current recommendation to the board, and this is what we'll be recommending in our final report, unless the government comes out with yet another update between now and then, is 1.1%. I suspect this is more in line with what IBC had in mind, but again, IBC didn't present a number, so I don't know if this is low enough for IBC. The health cost recovery assessment, the 2015 assessment, as announced by the government, was equated to a $120 million total assessment of the industry. Now, this includes private passenger, all vehicles, private passenger, commercial vehicles, and that equated to 6.44% of the third-party liability written premium. The government has not yet announced what that health levy will be for the 2016 year, and so we're tentatively recommending the same 6.44% premium, third-party liability premium, to be considered by the board and ensures that when they prepare their rate applications. But when the government announces its 2016 assessment, we recommend the board should consider that or make that the benchmark. IBC notes that the rate filings that will be submitted during this time period, the 6-month window that we're talking about, October 1st through March 31st, filings submitted during that period will impact policies not only that become effective in 2016, but also that become effective that will be effective during the 2017 year as well. So IBC suggests that given that the Auditor General has made some comments about the health levy future increases of $15 million or more above the $120 million, that the board should anticipate another $15 million, perhaps another $15 million increase above the $120 million for the 2016 assessment, and another $15 million increase above that for the 2017 assessment, and allow or accept that as its health loss recovery assessment benchmark, a number that reflects increases into 2016 and 2017. I suppose in theory, IBC's comments are appropriate. Rates are prospective in nature, and if the health levy is going to be higher in 2017 than it is in 2016, that should be considered in the rate setting process. However, how the board goes about estimating what that future increase in health cost recovery will be is a question. And should they estimate high? I doubt if insurers are going to return money to the policyholders for charging too much. So it's kind of an open question. We're recommending staying the course and just following the announcements made by the government. But again, I do want to report on what IBC's thoughts are on this particular issue. Operating expenses, again, companies really are required to reflect in their rate-making calculations or rate need calculations their own expense provisions. But the board is interested in knowing what the average expense provision is as reported by the industry, more as a perspective in order to kind of just assess the reasonableness of a particular company's overall operating expense cost. And GISA publishes a report that provides this information. However, the 2014 report has not yet been published, and I don't think it's going to be published until sometime in November. So we don't have any new information to present to the board, and we're just recommending, to the extent that is used by the board, to continue with the 2013 expense provision that was reported by GISA of 24.2% on average. And IBC commented on this. They said that the 24.2% represents a weighted average it's an average that considers the size of each company. So the larger companies carry more weight in arriving at that 24.2% weighted average number. I believe, if I understand IBC's comments correctly, that they believe that they're suggesting that a more straight arithmetic average should be considered, which would if calculated, would yield a 24.7% benchmark. I just suggest that, given the way the board uses this particular industry benchmark and the relatively small difference between 24.2 and 24.7, that let's stay. We're going to recommend continuing the 24.2% number and the weighted average that's published by GISA. IBC also points out or notes that the previous Alberta government had planned to increase the premium tax charged to insurers from 3% of premium to 4% of premium beginning in 2016, but that the new government has not yet stated its position on this issue or its intention on this issue. And IBC suggests that the board, to the extent it can, find out what the plans are with respect to the government plans are with respect to the premium tax, and if indeed the premium tax is going to be increasing in 2016, it should reflect that in the benchmark expense, or allow companies to reflect that in the expense provisions that they use to calculate their rate level needs. And one last, and this is the breakdown of the expenses. Again, these haven't changed since last time. They're just the 2013 numbers reported by GISA. You can see how commissions comprise almost half of the total expense, 24 expense level. My last comment is just on profit. The board's position on the profit allowance has been 7% of premium, again offset by, with claim costs offset by the risk-free yield. That position hasn't changed in this review, so we're recommending continuation of the 7% profit provision as the benchmark for this 6-month time period. So, Mr. Chairman, that concludes my presentation.
Does any board members have any questions for Mr. Zubelek? Thank you, Mr. Zubelek. There's no questions. So we're going to break for 15 minutes. And so right at 10:15, we'll have representatives from IBC make a presentation. So thank you.
I know. I know.
I gotta stand.
We'll be starting in about a minute, so if everybody could take their seats, and we'll have Bill Adams and Ryan Stein from IBC presenting shortly. So welcome. You can proceed if you like.
Good morning, and thank you very much for the opportunity to participate in the AIRB's annual review of auto insurance trends and rates for basic and optional coverage. I'm Bill Adams, Insurance Bureau of Canada's Vice President for the Western and Pacific region, and I'm joined this morning to my right by Ryan Stein, IBC's Director of Policy. Dr. Ron Miller, who you heard Mr. Zubelek refer to a couple of times, is IBC's consulting actuary, and he's not with us here today, but he did assist in the analysis that will be summarized for you over the next several minutes. The focus of IBC's submission and this morning's presentation is on 3 topics. They are the loss experience of the grid vehicle population, bodily injury claims trends, specifically those claims involving individuals with minor physical injuries, and the loss cost trend rates and other benchmarks that the AIRB will use when considering rating programs. I'll now pass the microphone over to Ryan, who will step us through our analysis.
Thanks, Bill. This graph shows the market share of the grid population for the past 5 accident years. The market share is based on the car years earned exposure. You can see that because of the 5% adjustments that the board set during the annual reviews in 2012 and 2013, the market share of the grid population declined by almost a percentage point between 2012 and 2014. We will see the effect of the 7% adjustment that the board set last year when the 2015 data is available. This graph shows the movement of loss costs for basic coverage for the grid population and the non-grid population for the past 5 accident years. The dotted black line shows the movement for the total market. While the increases to the grid-based premiums in recent years and the slight decline in the market share of the grid population affected the cost trend for the grid population to a degree, the graph still helps us understand the subtle differences between these 2 vehicle populations. Over the 5-year period, the loss costs for basic coverage for the grid population increased at a higher rate than the loss costs for the non-grid population. For the grid population, it increased by 31%. For the non-grid population, it increased by 21%. The largest annual increase happened between 2011 and 2012. Although between those years, the increase was larger for the grid population than for the non-grid population. For the grid population, the loss costs increased by 13%, and for the non-grid population, it increased by 7%. Over the most recent 3-year period, between 2012 and 2014, the loss cost for the grid population and the non-grid population increased at similar rates. For the grid population, it increased by 5.5%, and for the non-grid population, by 6.2%. This graph shows the loss ratio for basic coverage for the grid population and the non-grid population. You can see that for both the grid population and the non-grid population in recent years, the loss ratio has been well over the break-even point. For the grid population, the average loss ratio over the 5 years was 96%. For the non-grid population, it was 85%. You can also see that because of the different cost trend shown on the previous slide, the gap between the performance of the grid population and the non-grid population widened. It widened the most between 2011 and 2012, and then more or less stayed at that level. For the past 3 years, during which the recent increases in grid and non-grid premiums for basic coverage helped stabilize underwriting results, the average loss ratio for the grid population was 103%. For the non-grid population, it was 14 percentage points lower at 89%. This graph shows the frequency rate for bodily injury claims for the grid population and the non-grid population. Over the 5-year period, the grid population had more than 3 times more at-fault claims that resulted in an injury to a third party than the non-grid population. Our analysis of the underwriting results and loss trends for the grid population confirm that although the market share of the grid population has declined in recent years, there are still more than 160,000 vehicles comprising between 6% and 7% of the market, many of which are driven by the highest risk drivers in the province, paying quite a bit less than indicated for auto insurance. This table shows the loss costs by subcoverage for the past 5 accident years. It also shows the annual change. You can see that the subcoverage that sustained the largest year after year of rising claims was for bodily injury. The loss cost for bodily injury increased by 6.7% annually, which was almost 3 times faster than the rate of inflation. We examined the frequency rate and average claims cost to determine the cause of this development. During this time period, the frequency rate for bodily injury claims declined slightly, from 0.6 claims per 100 vehicles in 2010 to 0.57 claims in 2014. Accordingly, an increase in the average cost of a bodily injury claim was almost exclusively responsible for the increase in the loss cost. This graph shows the average cost of a bodily injury claim. The majority of the increase happened between 2010 and 2012. During this time period, the average cost of a bodily injury claim increased by 23%, from almost $40,000 to almost $49,000. Between 2012 and 2014, it increased by another 10% to almost $54,000. Last year, we conducted a study of closed bodily injury claims to help us identify any unusual claiming patterns that may have been the cause of the rising claims cost. The study involved the 14 largest insurers in Alberta and the largest servicing carrier for Facility Association. Combined, these insurers represented 84.1% of the market. They provided data on almost 2,500 closed claimant files with collision dates between January 1st, 2005 and December 31st, 2012. We set these data collection parameters to ensure the sample contained only files from post-reform collisions and had an adequate distribution of minor as well as moderate and severe injury files. In particular, we wanted enough moderate and severe injury files so we would be confident in any trends we identify with the data. Overall, 54% of the claimant files were from accident year 2012, 14% were from 2011, and the remaining 1/3 were from between 2005 and 2010. All claimant files closed in early 2014 or late 2013 after the sudden increase in the average cost of a bodily injury claim. This table shows settlement data for all claimants with a minor physical injury. Of the claimants who settled under the minor injury regulation, also known as the MIR, more than 1,200 had only a minor physical injury. Another 24 had a minor physical injury and an ancillary condition, such as jaw pain, an emotional disorder, or extended periods of pain. There were also 186 claimants with a minor injury who did not settle under the MIR. All of them had an ancillary condition. So overall, 89% of claimants with a minor physical injury and an ancillary condition did not settle under the MIR. The average payment for non-pecuniary damages and average total compensation to these claimants was considerably larger than the average payment and compensation to claimants with similar injuries that were subjected to the MIR. Overall, the value of settlements to those 186 claimants who did not settle under the MIR was $7.9 million. The value of total settlements to the more than 1,200 claimants who did settle under the MIR was $6.8 million. This table shows the loss costs by province for the past 5 accident years. Since 2010, consumers in Alberta and Nova Scotia have experienced the biggest cost increases among the provinces where private companies sell auto insurance. Although in Nova Scotia, the loss cost has been much lower than in Alberta, and the government introduced tort and accident benefit reforms that were meant to increase costs. This graph shows the loss cost for bodily injury claims going back to 1995 and projected to 2017. The gray bars are the pre-reform years. You can see how fast and how high costs rose back then, which prompted the government to introduce significant reforms. The reforms were effective as of October 1st, 2004, which is why on the graph, 2004 is shaded a little differently. The maroon bars are the years after the reforms, but before the sudden increase in the average cost of a bodily injury claim. You can see 7 years of cost stability. In 2010, the cost of bodily injury claims comprised 31% of total claims costs. The blue bars are the years after the sudden increase. By 2012, the cost of bodily injury claims as a percentage of total claims costs increased by 4 percentage points to almost 35%. The blue line bars are Dr. Miller's loss cost projections. They illustrate that without regulatory action to curb the cost of bodily injury claims, the loss costs could rise to levels not seen since the late 1990s and early 2000s. By 2017, Dr. Miller projects that the cost of bodily injury claims could comprise 37% of total claims costs, up from 35% in 2014. This table shows the loss costs by subcoverage from accident year 2014 based on the loss development factors that Oliver Wyman and the actuaries at Giza used, respectively. The columns in maroon show the percentage changes over a 5-year period. The column in blue shows Oliver Wyman's future loss cost trend rates. Oliver Wyman and Giza's loss cost estimates are almost identical. Dr. Miller also calculated the loss cost by subcoverage. His estimates were similar to the estimates from Oliver Wyman and Giza. We also asked Dr. Miller to examine Oliver Wyman's future loss cost trend rates. For his analysis, Dr. Miller calculated his own future loss cost trend rates. Dr. Miller's trend rates were similar to Oliver Wyman's trend rates. The only trend rate we do not have a lot of confidence in is for accident benefits disability income, which Mr. Zubalake already mentioned. For the comprehensive catastrophe provision, Oliver Wyman selected 40%. This provision, which is based on the average of the provisions using the past 10 years of loss data up to accident year 2013, is quite low relative to the 54% provision based on the past 5 years of data, also up to 2013. In the 5 years up to 2013, there were more natural catastrophes that caused more claims which had a higher cost than any of the previous years. For instance, between 2004 and 2008, there were 28 natural catastrophes. Between 2009 and 2013, there were 31 natural catastrophes. You can see on the pie chart on the left that between 2009 and 2013, there were a lot more claims from natural catastrophes than there were between 2004 and 2008. Between 2004 and 2008, there were under 45,000 claims. Between 2009 and 2013, there were almost 111,000 claims. The pie chart on the right shows that between 2009 and 2013, the overall cost of natural catastrophes was a lot higher than between 2004 and 2008. Specifically, between 2004 and 2008, the annual cost was $34 million, with an average claims cost of almost $3,900. The most expensive year was 2007, with $61 million in losses, which at the time was the most expensive year on record. Between 2009 and 2013, the annual cost was $115 million, with an average claims cost of more than $5,100. During this 5-year period, there were 3 years where there were more than $100 million in losses from natural catastrophes. There were $184 million in 2010, $171 million in 2012, and $131 million in 2013. Giza may not release the 2014 catastrophe loss figures until this fall. Nevertheless, the estimated losses from the 2 major summer storms last year indicate that 2014 was another year of high catastrophe losses. This graph shows the average yields on the 3-month Treasury bill and 10-year bonds, as well as the forecasts for 2016 and 2017 that Oliver Wyman used to select an investment rate of 1.5%. We note that Mr. Zubalake is reducing the selected rate to 1.1%, which is more in line, I guess, with the trend you see from the Bank of Canada with declining yields for both investment instruments. I'll now turn the microphone back over to Bill.
Thank you, Ryan. In summary, we would like to conclude our presentation by leaving you with a few key messages. First is that the underwriting results and loss trends for the grid population justify a significant increase to the grid-based premiums. At a minimum, the adjustment to the grid-based premiums will need to match the future loss cost trend rates for basic coverage for the total market. Further, we believe the adjustment should also reflect the higher cost trend and poorer underwriting results of the grid population. Otherwise, the gap between the competitively set risk-based premiums and the grid premiums will shrink, and the market share of the grid population will likely increase. Second, without action to fix the minor injury regulation, the cost of bodily injury claims will continue to rise at a steady pace and put more pressure on the premiums that all consumers are required to pay. While we recognize that this issue directly falls outside the board's jurisdiction, we believe that raising it in the context of this forum is relevant to setting future indicators. Third, insurers may file rating programs using reasonable trend rates and assumptions that may differ from Oliver Wyman's selected rates and assumptions. 4, changing climate patterns support using a comprehensive catastrophe provision based on 5 years of loss experience instead of 10 years, or at a minimum, a higher provision than 40%. And 5th, as we've already learned from Mr. Zubelik, current investment returns and projections for the economy justify, we believe, using a lower investment return than the 1.5%. And based on the province's new indicators, new projections, we're pleased that Oliver Wyman's recommendation will be 1.1. So with that, we'd like to thank you. We've reached the end of our presentation. We'd be pleased to respond to any questions the board may have.
Please, any board members have any questions?
Morning, gentlemen. Just a couple of points. I guess one is that in your request for us to consider your closed case study, you put us in a difficult position because you haven't provided us with your closed case study. So we can take your presentation, on its face, but we don't really have a sense of any of the background or the definitions or anything like that. So that's something you fellows may want to consider, and you don't necessarily have to answer here today. The second point I have, or something that seemed to me in listening to your commentary that seemed somewhat counterintuitive, was the assertion that even though the economy is in decline, unemployment is on the rise, you take issue with our actuaries' analysis of a reduction or a continued reduction in accident benefits being paid out. And it would seem, to me at least, that if fewer people are working, fewer people will qualify, and there'll be lower benefits paid.
I would, it's hard to pinpoint what the effect is of the economy on the trends. And I wouldn't say that we're necessarily taking issue with Mr. Zubelik's estimates. It's just, there's already uncertainty, and we're providing something else that for the board to consider. There's been some research done that the economy, to a degree, if a downturn in the economy could have an increase in everything from med rehab to bodily injury to disability income. I think at previous board hearings, some insurers have commented on that, and we're just trying to mention that this is something based on that research that could put just a little bit for the board to consider.
Thanks. We'd probably be interested in that research as well.
Okay.
Chris?
Yes, I direct my question to both gentlemen here. In your submission, you have said, otherwise, based on the forecast of IBC's actuary, the loss cost for BI claims will continue to rise and could return to levels that we have not seen since the crisis years of the late 90s and early 2000s. First of all, that's a fairly dramatic statement. And secondly, besides the minor injury regulation and just strictly premium increases, is there any other suggestions, recommendations, first of all, to the board or any particular regulatory body that we should be looking at to stem this statement and to stem the tide?
We think that the main component is on the bodily injury side. I think it represents, Mr. Zubelik said it represents almost 2/3 of basic coverage. I think it comes out to about 1/3 of total coverage. So, the main pressure is on that. We think it has something to do with those subset of claims that we mentioned through our study, and that's why that's the main area requiring regulatory reform that we've identified.
Okay, and you just focus on that. Is there any other, Bill, is there any other areas that we should be looking at?
Well, ultimately, we don't think that just simply continuing to increase rates is a long-term solution, particularly in this environment, this economic environment. People only have a certain capacity to be able to pay increased premiums. So ultimately, much the same way we did by engaging in discussions with government and superintendent's office and the department, we need to look at the results of the closed claim study to figure out what reforms we think might be necessary in order to continue to strike that balance of fair benefits for people who are injured and getting them better, and the premiums that all are required to pay. And that's always a delicate balance in every jurisdiction. We've had that balance in Alberta for a number of years. We think that's gone out of balance. So we need to see what can be done to tweak. And I use that term intentionally. We have a great auto insurance system in this province. It's not broken. But what we've seen, and we do see this repeatedly in jurisdictions, is that when government brings in reforms with a clear intention, they typically, when they meet that intention, over time, the impact of those reforms tends to erode. And we've seen that in recent years in Alberta. We need to acknowledge that. We need to reflect on it, and much the same way we did in 2003, 2004, consider what can and should be done to strike that delicate balance again.
Okay, thank you.
And with respect to, if I can, the closed claim study, I do believe that we had shared a copy of that previously with the board. I could stand to be corrected on that, but we have not done so in the context of this hearing. But we will certainly ensure that you are provided with a full copy of that.
I have one question as well. As a comment, we noted that the optional insurances and comprehensive insurance is being a little bit more profitable than the basic on average for the industry. We note that on the catastrophic loading discussion that there has been an increase over the last 5 years, but that's not indexed at all for the growth in the population or number of policies and premiums actually charged. It would actually be interesting to see, that worked in or factored into those increases, how much of an impact is number of policies and population growth has had on the increase over the last 5 years versus the last 10. I guess that's more of a comment than a question. But
We'll take a look at that in more detail. Just the little breakdown that we've done of the data, we found that the average cost of these claims has also gone up, as well as on a per capita basis, as well as the likelihood of them has increased as well. But we haven't dug any deeper than that.
all right. Norbert?
Mr. Chairman, thank you. I did have a question about interest or investment rates, but you addressed that, and from that I take that the 1.1% is in line with what you had in mind?
We didn't have a specific number. Our actuary, Dr. Miller, thought that 1.5 was a little high. He didn't give us what he said would be more appropriate. We're going to, 1.1 seems more in line with what we thought, but we're going to take that back to Dr. Miller to confirm.
Thank you.
Any other questions from the board? Seeing there isn't any, thank you very much for your presentation. We take your presentation in consideration. And I'd like now to call up the members from the Facility Association. We have David Simpson and Sean Doherty from Facility Association doing a presentation. Thank you.
and please begin when you're ready.
Thank you, Mr. Chairman. We do appreciate the opportunity to be with you again this year to provide what has come to be our annual update. With me today is Sean Doherty, Senior Vice President Actuarial and CFO for Facility Association. Mr. Doherty is a Fellow of the Canadian Institute of Actuaries and a Fellow of the Casualty Actuarial Society. And before I begin my prepared remarks, I would like to thank Mr. Zubelik particularly for his consideration of Mr. Doherty's and his team's input into the actuarial facets of today's hearing, and we very much appreciate his deliberate consideration of our input and his thoughtful and professional comments and fair-mindedness, and want to get that on the record. Thank you, Mr. Zubelik. We are here today primarily to provide the board and other interested stakeholders with our annual update on the Alberta risk-sharing pools for private passenger vehicles. We will focus on the size of the pools, their financial performance, and potential implications for rate setting. Our presentation this morning follows essentially the same format as prior years to make it easier for people that have been here throughout the years, make it easier to compare one year to the next. As always, we've tried to be brief to ensure there's time for dialogue and any questions the board might have. This slide shows the mission and vision of Facility Association. I don't propose to read through it verbatim, but as the slide indicates, we always want residual markets to be as small as possible so that consumers can benefit from the competitive marketplace to the greatest extent possible. And we want to be known as people who provide objective opinions with respect to residual markets and related matters. In Alberta, we operate two distinct types of residual markets. The residual market segment is for owners and operators of vehicles who are legally authorized to be on the road but unable to obtain insurance they need to operate their vehicles legally from an individual company. Vehicle types insured through the residual market segment include everything from motorcycles and snowmobiles through private passenger vehicles right up to logging and sand and gravel trucks. In other words, if it requires mandatory auto insurance, we're there to provide it. We also have a few thousand private passenger vehicles insured through the residual market segment. They're there only if allowed to be so through very, very stringent criteria. The other type of residual market mechanism we operate in, and the focus of our presentation today, are the two risk-sharing pools, and those are for private passenger vehicles, cars, minivans, light trucks only. Residual market segment risks are written at rates approved by this board for the segment. All intermediaries in the province have access to the residual market segment, and the consumer will always be charged the same rates for the same risk, regardless of the intermediary with whom they choose to do business. The rates and rules manual for the residual market segment may be found on our website, facilityassociation.com. Risk-sharing pool risks, on the other hand, are written at individual company authorized rates as authorized by this board, and then transferred to the pool behind the scenes by the insurance company. This behind-the-scenes sharing means that the risk-sharing pools are therefore invisible to the retail consumer. The financial balances of both the residual market segment and the risk-sharing pools stay within Alberta and are shared by Alberta automobile insurers on a market share basis, broadly speaking. That sharing is further refined by accident year and line of business. I use the word balances or amounts when I talk about sharing because not only bottom line results are shared. For example, premiums are shared as well, and member companies must pay such things as premium taxes and health levies on the premium amounts shared to them via the residual market segment and risk-sharing pool mechanisms. Our operations are governed by our plan of operation as authorized by the Superintendent of Insurance, and that document is available on our website as well. We welcome any questions from the board and other stakeholders about our operations at any time, and are of course always willing to meet with the board and others outside of this formal hearing to the extent that is helpful. Before I go into some detail on the specifics of the factors that govern the size of the risk-sharing pools, I'd like to note that in general, smaller residual market volumes are correlated with the degree of price competition allowed in the marketplace. In general, the more pricing freedom allowed, the smaller the residual market mechanism, whichever type is employed. Because of that, We believe that the relatively recent move to an individual company-based system of rate regulation, and move away from the industry-wide adjustment in Alberta, has the potential to result in smaller residual market volumes. We view that as being very, very positive and in line with our mission. Before I provide an overview of the current size of the two risk-sharing pools, I would like to take a minute to remind everybody about a little bit of background on what they are, why we have them, and how they operate. Risk-sharing pools are typically an industry response to an industry requirement that individual companies, through regulation or legislation, must accept business that they believe to be inadequately priced. They act as an industry-wide reinsurance mechanism that allow companies to mitigate the risk of having to accept that business. In Alberta, we have two risk-sharing pools created by the industry, one to accommodate policies subject to the maximum allowable premium under the premium grid, known simply as the grid pool, and another to accommodate business that companies must accept under the take-all-comers regulatory provisions in the province, known as the non-grid pool. All business transferred to both pools is written at company rates, as I mentioned, as mandated by the grid or as approved by this board. Pools are strictly for private passenger vehicles only. There are limits to the size that both the grid and the non-grid pool can reach. And those limits arise because there are limits on the number of exposures companies are allowed to transfer to each of the risk-sharing pools. For the grid pool, all risks which have their premiums capped by the premium grid are eligible, so the maximum size of the grid RSP is governed by the number of risks in the marketplace subject to the maximum grid premium, and we saw that sense of how much of the marketplace is impacted by the grid premium on the IBC slides. But from a practical standpoint, the actual number of exposures transferred to the grid pool is less than that maximum, as companies sometimes decide to retain grid-rated risks on their own books. For the non-grid pool, companies can transfer 4% of the total number of written exposures that they have not transferred to the grid pool. On a written premium basis, the total market share of both risk-sharing pools increased from 7.7% in 2013 to 7.8% in 2014. And that's the first premium-based market share increase we've seen in the history of the pools since inception. The pools were established in October 2004. From a written exposure standpoint, the total market share of the two risk-sharing pools in 2014 was 5.1%, up from 4.9% in 2013. As this slide shows, exposure counts increased in both the grid pool and the non-grid pool, but both on a written premium basis and on an exposure count basis, much more significant increase in the volume in the grid pool rather than the non-grid pool. Of course, those transfers represent the sum total of companies operating in the Alberta marketplace, serving the Alberta consumer. And when we break that down, we see that that sum total increase actually represents a variety of behaviors at the individual company level, and that's what we're really trying to show on this slide here. Because while overall transfers increased in both pools in 2014, at the member company group level, a little less than half decreased their transfers to the pool, a little more than half of non-grid pool users decreased their transfers. On a written exposure or vehicle count market share basis, Alberta continues to have the fourth largest residual market for private passenger automobile insurance in North America. This next slide highlights the volatility and loss ratio performance that the risk-sharing pools can be subject to. And previous presenters have mentioned some of the issues with challenges with coming up with estimates and the elements that go into that exercise. And from our perspective, and it's a little bit more challenging, I would suggest, than looking from the industry perspective as a whole, because when we saw that previous slide, companies withdrawing risk, other companies adding more risk in, the mix of business within the pools, even though their overall size might be relatively stable, is changing much more than you see across the industry as a whole, or as you would see at an individual company. An individual company's mix of business one year to the next will be relatively stable across the entire industry. Typically, the volume of vehicles in the province increase a little bit year to year, but the mix doesn't change dramatically. We can see that dramatic shift below a relatively stable volume amount, and that makes the initial estimates for Sean and his team and our consulting actuary a little bit more challenging than perhaps at the industry or company level. That said, each year our consulting valuation actuary, working with Sean, provides us with an estimate of the ultimate loss ratio for each accident year. And this slide shows how those estimates have changed over time. The estimates associated with the first estimate for any given accident year tend to be the most volatile, as composition of the loss ratio is more heavily weighted to unpaid claims. We've included the Alberta grid pool's loss ratios from the previous slide on the chart here, and also included the earlier accident years for the pool. The loss ratios have been segmented into paid, the blue section of the bar, case reserves, the red section, and IBNR, the green section of the bar. Very similar to what Mr. Zubelik put up in his slides earlier. As indicated, the loss ratios for the grid pool have fluctuated between roughly 60 and 75%. And I would note that for comparison purposes, this is a snapshot as at October 31st, 2014, the end of our most complete fiscal year. Monthly updates are posted to our website, and they're publicly available to anybody that might be interested to see what our latest estimates are. This next slide shows the non-grid pool's loss ratios, and in contrast to the grid pool, the non-grid pool's loss ratios are both at a generally higher level and exhibit a wider range, roughly 85% to 105%, compared to the 60 to 75% range we saw in the previous slide for the grid pool. In terms of financial performance, as shown in our audited financial statements, again available on our website, the grid pool is showing an accumulated surplus of approximately $62 million since inception, and the non-grid pool is showing an accumulated deficit of approximately $225 million since inception, for a combined deficit of $163 million for both pools. It's important to note as we talk about our financial statements, we can only portray, as required by accounting standards, the activities which happen within our walls, so to speak. But once we share those balances that I mentioned earlier out across the industry, they have to take additional factors into account. And on this slide, there are things that will show up in the company impact that will not show up in our financial statements, such things as health levies, premium taxes, income taxes, cost of capital, and investment income. In terms of potential market consequences, Alberta automobile insurers, through their compulsory participation in the risk-sharing pools and the sharing of the financial balances of those pools, cannot escape the fact that 7.8% of their premium volume is largely behaving in a way that is beyond their individual control. Because of that, there's always a risk that insurers may view the Alberta marketplace differently than they do marketplaces where they do have control over 100% of the premium they're responsible for. Ultimately, there is a potential for this to lead to the loss of competitive choice for Alberta consumers, in particular smaller companies which may not have the so-called deep pockets to bear the losses handed to them by the risk-sharing pools, may very well find it more difficult through time to support their share of risk-sharing pool business. Also, if the business transferred to the risk-sharing pool loses money, and we've seen that historically, especially in the non-grid pool, companies will then need to have higher rates on other remaining risks in the marketplace than they would otherwise to achieve their target returns. Even if the risk-sharing pools break even, rates on other business would have to be higher than they would otherwise in the absence of the pools. And it's also important to note, we believe, that risk-sharing pool results will impact different companies in different ways, depending on such things as the relative experience of what the business they transfer to the risk-sharing pools vis-a-vis the experience that they're required to bring back onto their own books via the sharing mechanism. And we would encourage the board to look at individual company pool impacts as they look at individual company rate filings and individual company rate needs. All that said, risk-sharing pools can be an effective residual market mechanism. However, because of the volatility they can present, we believe the focus in alignment with our mission should be on keeping them relatively small so that the volatility does not expose companies to significant financial risk. That is, with relatively small risk-sharing pools, large percentage changes in loss ratios are relatively small dollar amounts. Ultimately, we think all stakeholders share the same goal: a healthy competitive market where consumers benefit from multiple insurance providers competing actively for their business. Because we believe the risk-sharing pool should be kept as small as possible, we continue to encourage the review of eligibility for protection to the premium grid to ensure that it only applies to those risks it was designed for, and by ensuring grid rates are adequate. Other market rates need to be adequate as well. And as I mentioned a few minutes ago, we are encouraged by the recent move to an individual company file and approved system of rate regulation introduced relatively recently as having the potential to, through time, deliver smaller risk-sharing pool volumes. Also, given the comprehensive protection provided to the consumer by the premium grid, we believe there are additional steps which could be taken to further enhance competition below the grid to the benefit of Alberta consumers. Mr. Chairman, that concludes my remarks. We appreciate the opportunity to be with the board this morning. We're pleased to take any questions. Thank you.
Thank you. Questions from the board? Thank you very much. Oh, sorry, Ted, yes.
Thank you. Just to clarify, I always forget how this works, but if a risk is ceded to the grid pool, and to be ceded to the grid pool, it has to be on the grid, its rates have to be.
That's correct.
What happens if the board were to later increase the grid rates such that a particular risk no longer falls on the grid or is subject to the grid capping? Is it automatically pulled out of the pool?
Companies would be required to withdraw it from the pool. It'd be no longer eligible for the pool. They might take a look at the risk and say, well, we're still not comfortable with our price, so we'll send it to the non-grid pool.
Okay.
But absolutely, if the eligibility is very clearly defined.
Okay, so does the company, it's not something the FA monitors, the companies have to do it?
Well, the companies certainly monitor it, and we monitor it as well. We have audit teams that visit individual companies to make sure that risks ceded to both the grid pool and the non-grid pool are ceded appropriately, according to the eligibility rules contained in our manuals.
Yeah, okay, thank you. On slide 24, you mentioned as a goal and perhaps adequate grid rates. So are you suggesting that you believe that the grid should be self-supporting? Is that what you mean by adequate grid rates, or is there a level of subsidy that should be accepted? Or?
The preference from the standpoint of having it not have an impact on companies' decisions whether or not to bring in capital to write business, it should be self-sustained. But we understand that there's a social policy attached with that as well.
And along those lines, I think with slide 15, you showed the loss ratios for the grid, non-grid, and industry. Yeah. So just roughly, I think between years 2011 and 2013, at least the non-grid, the grid loss ratios are running, 6-7 points or so higher than the industry. Okay, but now in 2014, it's about the same. What do you attribute that? Is it more just a lot of uncertainty, as David mentioned, in the 2014 estimate, or the rates catching up slightly? What's causing now all of a sudden at least 2014, the loss ratios to be in line with one another?
My suggestion would be that this is more process variance than anything else.
Yeah.
You'll see that on the accident years, they do not necessarily all go up in one way. We have seen a bit of a decline.
Yeah.
The decline that we're seeing coming across here has been a reaction, we believe, to the rate increases that have occurred within the pool itself. And when the companies are ceding their risk to the pool, it's on an all coverages basis as well, so it's not just the basic mandatory coverages. And that may be having an influence as well. I would be hesitant to say that this is necessarily indicative of a trend. I think it's more process variance.
Okay, okay. Another question on slide 11 and 12, you commented on the size of the grid and noted that 2014 was the first year that there's been an increase in the population. What do you attribute that? Is that reversal of the pattern of declining market share?
The decisions made by individual companies on what to share is behind Chinese walls as far as we're concerned. We don't have insight into the individual companies. While the market share on the non-grid pool has been fairly steady, and you'll see it's a bit more volatile in terms of the market share. Yeah. What we were seeing was very significant declines happening on the grid side. And I believe what was happening was that a number of insurers were recognizing, originally when, and this is my interpretation or our internal interpretation of what we think had happened, was when the premium grid was first introduced, it came with an take-all-comers rule that was very strict. And so I think insurance companies at the time reacted to a set of risks that they were facing that they weren't sure that their prices were adequate for, because they were the types of risks that they wouldn't take on their books anyway through their underwriting and selection process. And so when faced with these risks for the first time that they had to take them, their initial reaction was then to take advantage of the risk-sharing pool and cede it off until they got comfortable with the experience that they were seeing come with those risks. And over time, we've seen a reduction. What we were seeing in throughout 2014, during the beginning of the year, was a continuation of a declining trend in the size of the grid. It was in the latter half of 2014 that we started to see a pickup, and there were certain companies that were sending in more. It may have been a reaction to the recognition that the trends on the bodily injury side in particular were more extensive than what they were originally anticipating, and they caused a reaction that they felt that the pricing on the grid was not at the level that they thought it was relative to the losses that they were seeing, so they ceded more in. 2015, we have been seeing declines again in the sessions into the pool so far for this year. And it's to the point where at 6 months, the number of risks actually seeded into the grid pool at 6 months is less than what's been seeded into the non-grid pool. And this is the first time that's happened on a sustained basis. But in terms of the seasonality of what gets transferred into the two pools, typically there's more risks that are transferred in the second half to the grid pool than in the first half. So we're anticipating right now that by the end of the year, even though it's 6 months, there's fewer vehicles on the grid side that have been transferred in. Our projections are to have that reversed by the end of the year, because there is about 10,000 more vehicles we're expecting being transferred into the grid pool as opposed to the non-grid pool. But nonetheless, we do believe that it will be slightly lower than what we're seeing here. It's very difficult to gauge, but.
And do you think that might be at least in part due to the increase that the board approved for the grid rates last year?
I believe that is the case. Now, again, the challenge is that it's individual company behaviors, and you'll see here, two companies had decided year on year to submit a significantly higher portion of risks than what they had in the previous year. Whereas on the decline side, there's only a couple of companies that were down in the 2,000, like this is 2,000 fewer year-on-year risks that they transferred, as opposed to this one company that transferred 6,000 more vehicles. So it's individual company behavior that really drives it. And you can see the same thing on the non-grid. There's a couple of member companies that transferred a significantly higher number. Now, this is on a scale up to 3,000, it's a scale up to 8,000, so you have to be a little bit careful comparing one to the next. But nonetheless, you can see that what was driving the increase was really the behaviors of two companies as opposed to what was driving the declines. And if you counted it out, the declines would end about here, and this is where the companies start increasing. And we just sort this by the number of transfers by the company. So 4 that were acting kind of similar to one another, and then in here, there are companies that are just moving in and out a little bit, not much going on. But you see the same sort of thing happening on here.
And Ted, maybe just to
Yeah.
piggyback
Yeah.
on that a little bit, one of the points we make in our written submission we didn't really emphasize this morning is that, as you know, the Alberta private passenger marketplace is relatively highly concentrated. 5 member company groups make up about 2/3 of the marketplace, so very, very sizable players relative to each other, so that decision-making at 1 or 2 large companies can change the overall number quite significantly and quite quickly.
Yeah. And one final question, which I meant to ask when we were on that loss ratio slide, I think it was 15. What is the, so we're showing a 70.3% 2014 accident year loss. So what would be the, call it the break even or the target loss ratio to satisfy that other objective as compared to the 70.3?
So this is indemnity only with
Yeah.
a little bit of adjustment expense. It reflects the way that we compensate the members for their claims expense. I don't have a number off the top of my head, but I would say it's somewhere between 55 and 57 would be the target loss ratio to make it, to make this a break even. So you're looking at probably a 20 to 30% rate increase that would be needed to get to that level.
And just to clarify, because I've told many times the board, when we look at industry numbers, that a 70% loss ratio, give or take a couple points, is kind of the target. So what's causing the difference again between what you just, the 55 kind of target that you're looking for the grid to achieve versus the 70 or so % target that I advise the board that is needed to?
Well, again, this is indemnity only,
Yeah,
so
so-
you'd have to put ALE and ULE on top of it, I believe, to get to the
To match.
70 to yours.
Yes, okay.
But, and if you take those out, I'm not sure what those ratios are off the
Yeah.
top of my head.
Yeah.
When we're looking at the farm private passenger in the current investment environment, for our private passenger rates and our expense structure, we focus on about a 54% target loss ratio. So I'm not sure where the industry is on
Yeah.
their expenses relative to ours. That's why I said somewhere maybe between 55 and 60, somewhere in there. And depending, if you're at 60, I believe a 70 or 72% loss ratio, you need a 20% rate increase for that. If you drop down to a 55, I think you're getting closer to a 30% rate need.
Okay. Thank you. Those are all my questions.
Sure, Jim?
I was just wondering, do smaller companies transfer a greater proportion of their business to the grids than larger companies?
Yeah, I think, without having the numbers for the detail,
Yeah.
right in front of me, what I've noticed in my tenure in this role, and it's not unique to the risk-sharing pools in Alberta, is that it really does vary through time. And sometimes you'll see, and small or large, you'll see companies changing their stance relative to a risk-sharing pool from one year to the next in quite a significant way. And it doesn't seem to be particularly associated with the size of the organization.
Yeah, I could see them using it as a risk management technique within the smaller companies, perhaps more than in a larger.
That's certainly because those financial impacts do affect them very directly, and because of the regulatory environment we have in the province, it'd be my expectation that very definitely they would use, especially both pools as risk management tools, yes.
What about my approach to marketing, direct writers versus brokerage? Do you have any sense on that?
We could undertake to take that back and follow up. We don't have that information at our fingertips right here, so we'd be pleased to follow up and provide that to the board.
I'd be curious if you can, if it's an easy job.
Or
whatever.
I can make it an easy job.
We're pleased to share whatever information we have.
Yeah.
So it'd be irresponsible to answer in detail in the moment because we don't have the information in front of us. But we're pleased to go back to the shop, get the information, share with the board and board staff, and then take things from there.
Fair enough. Thank you.
I would just like to point out that these are the groups that actually participated in, that is, they transferred risk to this pool during either 2014 or 2013. So there's 21 member groups. Within each group, though, they may have several individual companies. We just combine them all because the decisions on how much can be transferred and the limits are at a group member level, not at the individual company level. But there are a number of companies that don't participate at all in the risk-sharing pools other than taking on. They don't transfer any of their risk to the pool. So that's a consideration, certainly.
Mark?
So we've been talking about the grid as one singular entity, but it's made up of a number of different points on that grid. Any comments on the performance of either the grid overall in terms of adequacy of rates or the risk-sharing pool in terms of the segments of the grid that are seated to the pool?
When we receive the risk in, we don't have an indicator to tell us where they are on the grid. We receive very limited information in terms of what the member companies show us as for the transfer. So I don't have a specific comment on that. And because with respect to the industry-wide and all the stuff that's not into the grid risks, I don't have the resources to go and look at that. So it's not one of our focuses to see where the industry looks like on the grid.
What would it take for you to get the resources?
Board approval, I suppose.
That would be something under my latitude, Superintendent.
Any other questions from the board? Thank you for your presentation. We certainly will take your presentation into consideration when we're reviewing what our trends should be going forward.
Thank you.
Thank you. I can only attribute it to the chair's ability to run a very efficient meeting, but we're way out of schedule. As a result, Chris Daniels, the consumer rep, will actually make his presentation now. So I think we'll be done much earlier than expected today. Okay? And no one laughed. I think I'm funny. Unfortunately, nobody else does.
Thanks, Alan. And good morning, everybody. Okay, I think first my name is Chris Daniel, as some of you know and some of you don't. I see some familiar faces around here and some new faces, so always great to see you. As this is my first year, I'm going to say don't pick on me, but I'm not going to say that. I want to make sure, first of all, that the consumer voice is heard. So, currently I serve on the Automobile Insurance Board as the capacity of the consumer representative. And having been appointed in September of 2014. My role is to serve the board and to work with consumers independently in an environment that their views can be expressed, that are relevant and important to the insurance industry as it is today. A robust consumer voice is vital to the accountable and efficient delivery of automobile insurance in the province of Alberta. As this is my first year, I want to make sure that the consumer voice is heard. We have a diverse economic base as well as a geographic diversity at the same time. This position, I think, is integral, is an integral element to the board as it provides important and relevant feedback to the board as a barometer of consumer perceptions. It is important to note that my focus is on automobile insurance and not on any other elements of insurance. I think our work here and throughout the year as the board impacts directly on the consumers in Alberta, and we should never forget that. We deal in numbers, we deal in figures, but quite often we don't realize how much of an impact on the consumers the work that we do have. So having said all of that, how do you engage consumers to provide meaningful input and their voice will make a difference? So, the first thing I did was contract an independent research and consulting firm, designed questions that were relevant, sought questions from the stakeholders, and sought questions from the public. They in turn identified 800 individuals from various locations around the province that fell within different age bands. So if I was to just do a quick breakdown for your information, between 18 and 30 years of age, we had 70 individuals. Between 35 and 54, we had 272 individuals, and 55 plus, we had 458. The challenge is always to get the younger generation to participate. As well known, the younger generation has got away from landlines, and now they're on cell phones. They're busy, they're engaged, and so that is always a challenge to get them involved. However, we had 70, and then we had a number involved in the focus groups that I'll deal with a little later. A menu of questions was developed. We obtained those questions from stakeholders, from the board, from different elements. The survey questions are the consumer experience in obtaining automobile insurance, whether they shop for quotes, their experience in resolving claims, their impressions of premiums in Alberta, their views on user-based insurance, their demerits and increased fines for distracted driving, automobile insurance fraud, and government traffic safety programs. Those were the key elements of the questions. So, consumers have a right to receive insurance that covers, in my estimation, 4 key elements. They have to be affordable, stable, available, and the service element is the last. So let's deal with affordability. Driving a vehicle is not an option for many consumers, but a necessity for Albertans, young and seniors alike. We are a resource-based economy, meaning that many jobs are not within the realm of public transportation. Premiums, therefore, need to be affordable. They also need to be stable. Significant premium increases result in financial stress and sometimes lifestyle changes, so that needs to be taken into consideration. It needs to be available to all. Automobile insurance is a right to acquire to all citizens unless prohibited by law. And then the service, consumers expect to receive good service. So if I deal with the synopsis of what I gathered over the survey, and this is very, very brief because I did receive a lot of feedback, believe me. More discounts for better drivers. I think that's one that's been paramount for a number of years, and is one that I think we need to focus on. More severe penalties for distracted drivers. Now, we see that every single day as we drive. And yet, I got that from every single member of the public that we talked to, that we've had in focus groups, or that we phoned. Improved consistency in road signage throughout the province. This predominantly came from the seniors group, where they rely on consistency of road signs. Whether, and I don't know anybody been on the Anthony Henday, whether you're going left or right, whether you're going east, west, south, or north, you have no idea. Sometimes you have to turn left, sometimes you have to turn right to get on to go west. It varies. You go down between Edmonton and Calgary, you have different set of signage. So I think this is one of the things that I got back, which was very important, that we have consistency of signage. Improved driver education programs. More emphasis on enforcement and detection of high-risk drivers. In general, the focus groups were very engaged. They gave us a lot of feedback, a lot of information. The other group that I added this year, and it's not because of my age, believe me, I added this as a seniors. Why did I put this in? Why did I want to speak to seniors? Well, firstly, we are an aging population. I think that's obvious. Secondly, it's a group that I feel should be engaged in providing feedback on insurance, because insurance is critical to them for their freedom of lifestyle and from being able to get around. And so this group surprised me. They were very engaged. They gave me a lot of feedback. I could have probably spent 2 days with them. They were thoughtful, they were specific in their comments, and they, I say, gave a lot of good feedback. So let's deal with some of it. User-based insurance for all seniors. They felt this is a great tool, and I'll cover user-based insurance in a little while. But they felt that was a great tool for seniors to abide and live by. They felt it was an opportunity for them to get discounts on their own insurance. Systems to deactivate cell phone use. I thought this was quite something. They felt that getting people to change habits is very difficult. And so what they were looking at is saying, you jump into a car, other than 911 or emergency phone calls, that immediately that cell phone disengages and they can't use it. Very interesting. Winter driving courses for new drivers. That was an interesting one. They felt that we have a lot of immigration in this country and in this province, and that should be an element of getting your driver's license and completing it, or of graduated licenses, that should be an element of winter driving. Signs that display driver speed in high collision areas. Something that we've seen, I think, develop over the last few years via Alberta Transportation, but they want to see more of it. Especially in, say, high collision areas, areas that are subject to pedestrians, subject to high volume. So I think everybody probably knows it's a speed that will display your actual speed when you're driving. And I'm sure we've seen it on Highway 2 going south in the construction areas. Increased penalties for subsequent offenses, in essence, cascading fines. Something that certainly I hadn't even considered, and I don't think we had considered. So the first speeding fine is X, and the second one is Y, and the third one is Z. So it gradually increases. So it's a penalty beyond a penalty. And so I thought that was an interesting one. And improved road markings. I think that's of going back to road signage, road markings, when to have a left turn lane, when to have a right turn lane, those type of things. Another thing that came out of the seniors group was the driving habits of seniors. And they differ, I think, from the regular population. They tend to drive mostly out of rush hours. So they stay away from rush hour. They don't drive predominantly at night. They drive less mileage. And so I think that's what attracted them so much to the user-based insurance concept. That if it is approved and put into place, then I think this is a group that will take advantage of that as soon as it's done. And as I say, they drive less mileage. So our population is aging, and in consequence, I think it's relevant and it was important to engage this particular group. So what I found in some of the elements of that we talked about, the 4 pillars that I talked about of affordability, and so the first thing is premium affordability. So 59% of consumers surveyed agreed that the premiums are fair and reasonable, and that's up from 57%. Again, this is the barometer for the board to look at and for the industry to look at, is how well are we delivering on affordability on the premiums. So I think we've all heard this morning that premiums have stabilized over the last 10 years. However, we've now seen that losses are increasing, and therefore there's a pressure on premiums to increase. And this is a good barometer of how we've seen that happen over the last few years. So the consumer feels that, in essence, that and nobody really loves to pay insurance. So having said that, I think that's a good comment getting back. Good drivers still feel they pay too much. I think that's always been the case. They would like to see more discounts for good drivers, again, user-based insurance. So having said that, in premium stability, I think this reflects the average premium paid by consumers over the last 10 years, as reported to the insurance company's statistical body. As you will see, the premiums for
Excuse me, Mr. Chairman. Mr. Daniel had provided us with an update to this slide, and this isn't the update. So the basic coverage, the blue line, which starts at 56, should be flat.
Right.
So we can either pull up the slide, but it'll take a couple minutes, or if you want to
Okay,
just talk
that
through it.
in fact should be flat, thank you. Okay, thank you. So, in essence, you'll see the 2014 figures compared to the 2005 figures. The basic coverage has decreased by 5%, as I think is evidenced by the consumer opinion that it is fair and reasonable and it has stayed flat over that period of time. Additional coverage, however, has increased by 42%, and the coverage has increased, total coverage combining the two has increased by 13%. The CPI in that comparison is the comparison for a statistical estimate constructed using prices of a sample of representative items whose price is collected periodically and compared on year-to-year basis. Going now to availability of insurance. Over the last 7 to 8 years, we have seen a gradual decrease in the number of convictions without insurance, except for the last 12 months. This is a good barometer and a good indication of how people with high-risk areas are either insuring or not insuring, and the cost of insurance for these individuals. So I think it's indicative of how we are performing as a board, how we are performing as the industry. So if I look at why there is a possibility of increasing in 2014 and 15, I can draw some conclusions. They're not 100% accurate, but they are increased police activity, which I think we've seen. The economy has certainly had an effect on it. And drivers with high risks or are determined to be high risk could pay anywhere between $4,000 and $7,000 a year for insurance. And therefore, this is an indication of can they still afford insurance and are they going without insurance. It is important for us to not price the premium level to an extent that it forces people not to insure, and it forces a punitive. I think that we all know that insurance, in general terms, reflects that we insure the many for the risks of the few. So it's a spread of risk. And so it's important that everybody should be available to have insurance. And the last element is service that takes on many facets. It involves an area of claims, it involves an area of education, it involves an area of accessibility. And generally, our population is satisfied with the service elements. So our balance over the years is that what the consumer feels in relation to the high risk, that there is an element of high risk drivers. And it is always a balance between those two of good drivers and high risk drivers. And the premiums must be affordable to all. So that balance must exist between the good drivers and the high risk drivers. Alberta has an all-comers rule and must avoid the high risk drivers driving without insurance. And so that is a key element of what the board does and what the consumer should be receiving. So if I look at now the average provincial premium and compare the premiums that are paid in Alberta with the rest of the country, there are many factors that differ in different parts of the country. But if I look at Alberta compared to BC, and these rates are basically the average premium paid by consumers. So they're all based on roughly the same comparison. So if I look at Alberta and BC, ironically enough, almost identical. New Brunswick, Newfoundland, Nova Scotia, Ontario. One might ask, why is Ontario so high? Well, there is a huge difference in benefits that are supplied to the policy in Ontario that are necessary compared to Alberta and BC. So each one has a little different, but that'll give you an idea of the variance between the two. Okay, so in general, consumer complaints, the Office of the Superintendent has a record of consumer complaints. And it is broken down into a number of different areas: automobile premiums, grid levels, cancellations, underwriting, adverse contractual actions, and claims. This is another barometer that one could look at to see how the premiums in Alberta are standing up to the consumer needs. And it is encouraging to see that premiums is not an issue today and is not increased as an issue with the Superintendent of Insurance. Probably what has increased is the claims, but that is another area outside of our jurisdiction. I think it's important to see that that this office is keeping a record of these particular phone calls, and that we are have access to that to know as a benchmark of how we are performing as a board. We also deal with traffic safety. While injury accidents on a per capita basis have been declining, we are showing a moderate increase of 2.4%. Why is that? Is it a population increase? Is it high collision areas? The traffic safety of Alberta transportation deals with looking at high collision areas and trying to avoid and come up with suggestions on how to eliminate those areas. And so they look at sight lines, they look at high traffic lights, they look at stop signs, they look at how they can improve on that. So the survey, 86% agreed that traffic safety should be a priority, and they also agreed that the Alberta Transportation is taking the right approach to looking at intersections where there is high collision areas. Competition is another area we looked at. The survey, 27% of consumers obtained a competitive quote, slightly higher than previous years, which I think is good. It means that generally the insurance industry is encouraging people to shop around and look for other coverage. We live in a free market province. The consumers have a right to choose, and therefore we encourage, and I think the insurance industry encourages, that people will shop around. Of those, 89% remained with an existing insurer, consistent with the past 5 years. And I think that's a good sign. It means that generally speaking, the consumer is satisfied with what they're getting from their present company. If we look at one of the areas, and one of the questions that we focused in on was distracted driving, the respondents felt, I think unequivocally, that the current laws are not enough to discourage distracted driving. And I think that the fine, I think, is going to be increased, and demerit points to the current government look at that. But it has been recommended that demerit points be put into distracted driving. 84% of those surveyed felt that the penalties are inadequate, agreed that demerit points would increase the compliance. I'm sure you may or may not be aware, just recently in Edmonton there was a survey, not a survey, but what do they call it, a sting operation, I think that's what they call it, where they were targeting distracted driving. Why was that done? That was done because a young lady was killed late at night, and she was texting her boyfriend, and they found on the floor the cell phone, and she was a single vehicle accident, ran into a pole. And just at the time when the accident happened, there was a text coming through, which would indicate that the young lady was texting at the time of the accident. I don't know whether any of you have seen that ad, and I think it's a great ad by Volkswagen, where everybody's in a movie theater, and they bring this ad on, and they're showing somebody texting. And then, I don't know how they did it, but they were able to get everybody's cell phone to activate in the theater, in the movie theater. And all of a sudden, everybody looks down at the text, and when they look up, there's a crash. And it just shows you that these things can happen in an instant. And so I think distracted driving is something that I think is going to help if we increase the penalties. So, having said that, user-based insurance, if I move on to that, the definition of user-based insurance is right there. It's also known as pay-as-you-drive and pay-how-you-drive. A mile-based automobile insurance is a type of vehicle insurance whereby the costs are dependent upon the type of vehicle used, measured against time, distance, behavior, and place. I don't think I've heard anybody not want this put into place. I think it's the consumer is looking to have this as an opportunity to provide an additional discount to their current premiums. However, there is a proviso, and the proviso is that they're concerned about the privacy issue, and that is a huge issue that I know the regulatory bodies are looking at. And the sharing of information of that between insurance companies. But the good news story for drivers with good driving habits and lower usage, such as seniors, will benefit from this type of discount that being put in place. So good drivers and experienced drivers with good driving history should pay less. As UBI becomes more pervasive, risk may be that poor drivers pay more. And this is an important element that I think the board has to look at, is that if you're reducing the cost for these drivers, those people that don't participate in the program pay more. And so one has to be cautious of that. Consumers are interested in user-based insurance, but have concerns and questions about privacy and access to data. I've said that. I think that's very important. There are a number of different organizations that prefer a universal platform as an individual company platform. At this point in time, individual companies are providing their own platform, and it is in use in Ontario, in New Brunswick, and in other provinces. So that is just one element of it. And this is one of the questions that we asked of our focus group and our telephone survey. The next one is organized crime that we were asked to put on by one of our regulatory bodies. There's no question that organized crime is a concern in Canada as a whole, and has been in the US, predominantly in the New York State and several areas down there, that organized crime has become a huge element within insurance premiums today. And so there's no question that organized crime will result in increased premium. And so one of the questions that we asked was whether the consumer felt that this was a key element in their insurance premiums, and should they be concerned about it. Ironically enough, not a lot of consumers were aware of this, and I think whether that's a job of the government, whether that's the job of the insurance industry, whether that's the job of regulatory bodies, to inform the consumer the resulting effects of organized crime. And just to give you a little example of an organized crime is staged collisions, and I'm sure you're all aware of those type of things that can happen. They're more predominant in Eastern Canada than they are in Western Canada. So 71% of the respondents indicated a high level of concern, and 82% of the respondents were in support of initiative to pool insurance-wide insurance data for the purpose of detecting and preventing organized fraud. This is something that has been put in place in Ontario, and it's something that we will have to look at as we move down the road. And again, the concern is from consumers is the sharing of data and how well it is protected. But what's nice to see is that they are concerned about it and they are willing to share that data. So conclusions, automobile insurance is affordable for most drivers. Rates are stable. Total premiums have increased by less than 1% since 2005. All-comers rule continues to be effective, making insurance available. Consumers indicate their experience related to customer service for both the purchase of insurance and claims is favorable. So, bringing this presentation to a conclusion, things that we have to look at is gradual increases in rates are preferable than significant hikes in 1 year. User-based insurance is introduced to ensure that rates for non-participants are fair, particularly for additional coverage. And rates for new drivers and for those with poor driving record are to be fair and not punitive. So that concludes my remarks. in general terms, consumers are satisfied with the premiums and the delivery system that we exist today.
Thank you, Chris. Any questions from the board? Having none, I think that concludes your presentation. Thank you very much, Chris. We are ahead of schedule. We will break for lunch right now. We will start up right at 12:30, and with TD's presentation, followed by Aviva. So thank you very much, and we'll see you at 12:30. Well, welcome back, everyone. We'll get started in a few minutes. Aviva it was scheduled to present right after TD. They have had some issues with their travel plans. They are on the way, but they will be delayed. So we'll proceed with TD's presentation today. Then the board will break again for, we'll go and have an in-camera session. And hopefully Aviva can make their scheduled time at 2 o'clock. Then we'll return for that presentation and close the meeting after that. So thank you very much for the members of TD to join us. Maybe you can make an introduction for us, for the board.
Sure.
And you can begin with your presentation when you're ready.
Sure.
Thanks.
Well, we'd like to thank the board on behalf of TD Insurance and myself, Moira Gill, Ted Coliff, and Jean Waugh. We're very pleased to once again be part of this annual review with you. We thought we would start the agenda with a little bit of an overview of TD Insurance so you understand our specific comments about the environment for rate regulation in Alberta in the context of our own operations, and then we'll move on to some more specific comments. It's important to understand our company in that we are part of a large financial group and the implications that that has for our operations. It's also important to understand that we are a direct response company entirely, and that we have a strong focus on group insurance. In other words, we are focused on mainly on affinity market, although we also have other direct business. We'd also like to highlight our operations and our position in Alberta. You'll note that we have a higher market share in Alberta than we do our overall national market share for the rest of the country. And we have an increasing market share in Alberta. We are also part of a significant TD Bank Group participation in the Alberta marketplace. And we're certainly focused on the community and service in the community in Alberta. A few points about the TD Bank Group, because that's significant in terms of our operations. The size of the TD Bank Group is significant in the resources that TD Insurance is able to employ, especially around the areas of customer service, which is a very important focus for both us and the larger operations of the banking group, and also the focus of the entire banking group on risk management. It is very important to understand our operations. It's a cornerstone of everything that we do, and you find that for our operations, for example, investment policies and similar aspects of our operations, we are very, very conservative in line with our larger parent operations.
Thanks, Moira. Just a few words about loss trends. This slide shows a summary of frequency and severity changes from November 2014 through April of 2015. It's important to note when we look at these numbers that there's been no change in our training practices or reserving philosophy over that time. And claims advisors have not changed the process by which they assess or reserve claims for injuries or for physical damage. You can see in that time period a frequency change in bodily injury claims of 3.9% and a severity change of 1.9%. And in property damage, a frequency change increase of 6.2% and an increase in severity of 4.8%. The increasing severity of bodily injury claims is resulting from increased incidence of claims being settled outside of the minor injury cap. And the severity increase of 1.9% has been influenced by a number of factors: Sparrowhawk decision, the introduction of new heads of damage that weren't previously presented in bodily injury claims, and changing plaintiffs' counsel strategies to avoid the limitations of the cap, as well as just a general increase in overall claims costs.
The board asked for some input into the combination of the ULAE as was highlighted a little bit before. The comments we're making are more in relation to LAE versus ULAE, and although they are our comments, I think they are reflective of things that are happening in the industry as a whole. So our own organization is slowly shifting and making investment either in hiring internal lawyers, as well as internalizing more aspect of things that we used to have to rely on outside adjusters, either because we did not have the volume to do it effectively ourselves. And as we're getting more and more customers, we're attaining critical mass that makes it more effective for us to do that, both in terms of a consistent approach to the settlement of our claims, as well as a more efficient approach in terms of the cost dollars that we're allocating to the settlement of the claims. And because of that shift, and we believe that we are not alone in making that shift, excluding ULAE, where that shift is happening towards, would actually put a bit of a artificial cap, if you want, on the trend that you're seeing on the indemnity plus the ALE cost. So we believe that a more proper approach would either be to look only at the indemnity side, like Facility Association did, or to include both types of adjustment expenses, so that you're not misled by that shift that's happening between the allocated, which is on the individual case basis, and the ULAE, which is more an adjuster employed by the company handling multiple claims, and the salary not necessarily being adjusted, assigned to an individual claim. Some comments on the Oliver Wyman. First, there was a small element I'd like to correct from your presentation. TD is seeing a step change as well in their claim cost. We are not seeing a 5% step change. We're seeing something actually a little bit higher than 15% on our own claims around 2011. So the trends that are shown by Oliver Wyman are in line with what we're seeing. They seem reasonable as well, and my colleague Ted mentioned, there's a number of things that we seem to be seeing internally that seem to be pushing the claim costs in that direction. The biggest one, and the timing of which is kind of the culmination of a bit of pressure from 2010 to 2012 on the DI side, which is the Sparrowhawk decision. Because the most recent years are very immature, we recommend caution in lowering the cost for BI especially, below the number selected by Oliver Wyman. our own trends are a little bit higher. They're in line, but they're a little bit higher. And we are seeing in our own internal data quite a bit of a shift that's happening between, despite the indexation of the minor injury regulation, a shift that's happening between claims that we felt when we were first receiving them would fall under the minor injury regulation and end up being settled outside of it. And I think you saw from the numbers from IBC in their closed claim study, up to which we participated, that the differences can be significant whether or not the claim is classified as a minor injury or not. So in closing, we'd like to support the statement made by the consumer advocate. We've made it here a number of times in the in-stride adjustment as well as previous opportunities to present to the board that we believe a moderate approach on a regular basis is preferable from a consumer perspective to large increases followed by no change followed by large increases. So it's easier to manage, it's easier to budget, and makes for a more manageable process as a whole. We believe, based on the trend, that a small increase will be required to keep premiums in line with the cost. And again, recommending some prudence because there are a number of things that have been happening since 2012, the effect of which are far from clear at this time. And I guess that's the end of my line.
Well, thank you very much for your presentation. Do we have some questions from the board? Charlene, please.
Thank you. Thank you for your presentation. Good information. Just a question on slide 6 where you're talking about the frequency and severity changes, if I could just get a bit of clarification. On the bodily injury, you're talking about a 3.9% frequency change and a 1.9% severity increase change. Was that really just over that 6-month period you saw that change? Or like what is the time period on that?
That's the increase in our incurred claims over that time period.
Over 6 months?
That's right.
Okay, and does that just include the reported claims costs, or does it also reflect your development factors in that?
It's an incurred number, so it includes claims paid and case reserves.
But not
only.
the other element that...
and no development, no factors for development?
No development,
okay.
No bulk reserve, no actuarial reserves.
Okay, thank you.
On slide 7, you mentioned plaintiff's counsel strategy to avoid cap limitations. Can you elaborate on that statement?
We're finding that they're, in general, becoming more resistant to early settlement. Our efforts to settle claims earlier in the process, they're becoming more resistant. And as I think we have mentioned in the past, we're seeing those claimants who are represented by counsel tend to be presenting more claims for the TMJ disorder, for chronic pain, and for psychological related injuries.
I'd also say that consistent with the comments from the IBC, as the understanding of previous reforms gets better year over year, we tend to see the effectiveness of those reforms diminish as different participants in the process understand and learn how to utilize strategies in those reforms. So that would be consistent with what the IBC has mentioned, and the need to do some tweaking on the regulatory front as well.
Chris, you have a question?
I've got excuse me, a couple. Relative, and you were here for the presentation on what I just did. So I got a lot of feedback on discounts, on areas that the consumer can take more control of their premium. And they were specifically referring to discounts. So probably, Sean, I'll refer it to you. Mm-hmm. Have you looked at, in the future now, any additional discounting. So it's number one that you could potentially implement or you're looking at implementing. So number one. Number two, have you implemented user-based insurance in any parts of the country, and are you considering that? And three, sorry. I said two. I could keep going. No, but I think the other area that I got, and I didn't really bring it up, but was transparency. And many consumers find sometimes they find it difficult in this complex world of rating, is actually finding out how their policy is determined. And as we get more sophisticated in our approach to automobile insurance, and then trying to find out what elements are made up. So I know there's three questions, and I'm going to be cut off here anymore, so there you go.
Okay, let me start with the first one. And you're asking for certain elements that I won't get into the specific. They're kind of competitive information. I think this is not necessarily the forum, but we would be available if you want more details on to the board in a separate discussion. So yes, we are looking at a number of things. We've put some things outside of Alberta that we'd like to bring that recognize a little bit more the good driving experience of our customers. I'll skip to your last element around transparency. We are getting the same feedback from our customers. We tend to, as a direct response insurer, have to have those systems that brings us that feedback, and we're looking at changing a little bit how we're displaying that information, so they really have a better idea of this. I have some control. I made that decision. It has this impact. If I make it differently, it will have a different impact on what I'm doing. And on the last one, I guess I'll go back to my statement that I'd love to give more details to the board, but this time I'll just say that like many of our peer companies, we are looking at the implication of usage-based insurance.
Okay, fair enough. Thank you.
Great. Ted, do you have some questions?
I just want more of a clarification. Slide 9, you comments on the Oliver Wyman report slide. Yeah. Now, what are those? I was just a little confused. What are those trend numbers? Are these your trend calculation? What your estimates of the trends are, or?
I believe yes, they are from our submission. So that's what we're seeing on our side.
Okay,
Let me just double check in our paper submission.
Yeah. I didn't see those anywhere. That's why
Can I get back to you? I'll
Sure.
just make sure that
Yeah.
I'm giving you the correct
Okay,
answer.
fine. That's fine. Thank you.
Is that the only?
That's all.
Okay.
Yeah.
I got a couple.
Yes, go ahead, Jim.
If you can just go to slide 7, just so I can refer to it. Second point indicates that housekeeping is a new head of damage. Take me through that.
It's not new. Sorry.
I'm just reading it.
Yeah, what's new is that we're seeing it on virtually every claim being claimed as part of the claim. That's new. It's not a new head. It's that every claimant tends to be making a housekeeping claim now.
And take me through your analysis of how prejudgment interest, which is statutory, how that could be increasing.
I think all we mean there is that as general damages increase, so too do the PGI component. Not as a percentage, but just as a total number.
There's a comment from Ted earlier, if I may, around one thing we're seeing is more plaintiff counsel involvement and a delay in the settlement of the injury. So that pushes the timeline out for our settlement and increases the absolute dollars. So the rate doesn't change, but it's just because it's a longer period of time and the awards tend to be higher than the prejudgment interest is proportional.
Internally, as you adjust claims, do you have time requirements that push matters to litigation, whether or not the plaintiff's lawyers wanted to go there?
Time requirements that push matters to litigation. So I would say no.
Okay, I'm not trying to set you up here, but you do. And I'm just trying to create a broad base for our group. And for example, if a 2-year limitation period passes on a case and I issue a claim for an individual, your adjuster has 6 months to settle a file with me. That's all they get. Then it goes to counsel. So it's not, I guess I'm looking at whether internal adjusting and policies may have as much of an effect as the folks that you're blaming for delaying resolutions to claims. And I just wanted to bring that to your attention, that if I act for a paraplegic client, we might be able to settle that case, but not under the restrictions that at least your Calgary offices are under. So we can't.
So you're saying that our internal policy is that the claims advisor has 6 months to settle the claims directly with you, or they then go to counsel?
There's time limits that take place after issuing a claim and time limits that take place after the service of a claim. So if I call an adjuster and say, we can work this out, don't send it to defense, don't pay somebody $700 an hour to argue with us,
right.
It's not an option. So I'm not trying to cast any aspersions, but I'm trying to just give our board a sense that it's perhaps not everybody on one side of the fence firing arrows over and everybody on the other side of the fence just ducking.
Fair enough.
So, thanks.
Thank you.
Any other questions from the board? Well, thank you very much for your presentation. Again, we'll certainly use the information when we deliberate on what we're going to set for guidelines going forward. Aviva had a scheduled time at 2 o'clock. We hope that they will be able to make it, so we're going to break until 2 o'clock. Sorry, go ahead.
Just
Dallas.
received an update. It looks like they landed about 12:30, so they'll probably be here by 1:30, I guess.
Okay, well, then let's break until 1:30, and hopefully they'll be there then. But the board will just deliberate on what we've heard so far up in the AIRB offices right now. So let's convene up there, and we'll see those that can make it back at 1:30. Thank you very much. Welcome back, everyone. It's nice to see a lot of people could stay. We had a couple extra breaks. The crowd is thinning a little bit, but we're still all here. Just want to, before we begin, mention that at the beginning there was a number of reports cited as being submitted. They will be posted on our website. We have also received such a report from Intact, so for the record, I'd like to mention that we'll be posting Intact's report on the website in due course as well. Welcome, Aviva. I'm glad you guys made it safely.
Thank you.
We did manage to get through all the other agenda items, so you're last up, and I'm going to turn the floor right over to you. You can maybe introduce yourselves to the board and proceed with your presentation when you're ready.
Thank you, Mr. Chair.
Thank you.
And thank you for your patience. Obviously, it was not our intention to show up late to this hearing. A delay in Toronto and then a medical emergency on board the aircraft caused us to land on an emergency basis in Winnipeg. So I feel like I've seen most of the country today and just this morning. Anyway, but thank you for your patience. We appreciate it. My name is Sharon Ludlow. I'm the president of Aviva Insurance Company of Canada. To my left, Kristen Gill, who is one of our vice presidents in the personal lines area. Karen Otts had a family emergency last night, so she is not with us today, but she certainly sends her regards. I'm told that we have submitted a presentation that's in PDF, so periodically I need to point to this gentleman to move or change the slides for me since I'm not in control of them. So if you think I'm waving at someone periodically, it's simply to keep us on track. Our presentation today will cover a couple of things. We'll move to the next slide. Talk a little bit about Aviva, who we are. We'll do that very briefly, and what we mean in Alberta and what Alberta means to us because it's so important. We'll talk about our experience in loss trends and what we've seen in the Oliver Wyman data. And then, of course, we'll get right to sort of the substance of the issue with the causes of bodily injury severity. And we have a number of different areas within that we'll talk about. We'll conclude with our thoughts on the ULAY and then just some remarks at the end to sum it up. So a little bit about Aviva, if we could change the slide. Second largest property and casualty insurer in Canada. You've heard from the largest, I think earlier today, I heard that referred to, and number 6 in the world. We have in excess of 33 million policyholders around the world, 3 million of them across Canada. In Alberta, we have in excess of 200,000 insureds from an automobile basis. We work with over 200 brokers in this country, and given the fact that last year we handled more than 17,000 claims, we think we have a pretty decent feel for automobile claims and their handling in this province. Go to the next slide, please. We're here today to talk primarily about what we've seen with the Alberta auto results. And the headline at the top of the slide says that we're concerned. I haven't had the benefit of hearing other companies today, but I wouldn't be surprised if you've had the same message or exactly the same words. Over the past 3 years, we've seen a general deterioration in results and primarily driven by bodily injury. And again, as I said earlier, that's where we're going to spend some time. What we found when we looked at Oliver Wyman data, although we feel that it is generally reasonable for point-in-time study and data results, we do feel that some of the recent, and in particular one recent court decision, is causing uncertainty in that area and therefore may cause some of the results of that study to be underestimated. The other thing that we find that's an interesting feature when the primary cause is BI is that given that the length of time is so much longer than other types of claims, it also causes much more uncertainty. And in our experience in the claims we've seen, BI claims and those particularly with legal representation on average take about 4 years to settle. And so that's a fairly long time when you're trying to predict or draw a conclusion at a single point in time when you haven't had the benefit of the fullness of that 4 years to see those claims come through to fruition. I'm going to turn to Kristen for a minute to talk a little bit about what we've seen in our results versus what we see in the Oliver Wyman results. Kristen.
So our market share is about 6.5% of the Alberta province. So naturally, our own results are going to be much more volatile than the industry results. Specifically with BI, with all of the different changes and legal decisions, and we've also had some internal case reserving changes. So when we look at our own data, we do see quite a bit of volatility. However, that being said, I would say that our analysis would point us generally in the same direction as both the Oliver Wyman and the Ron Miller analysis. Where a difference might be is we have seen similarly a decreasing in the BI trend, but that has changed in around, I believe it was 2010, where we started to see BI increasing a little bit up until the end of 2013, and then it dropped again. So it's hard to say again whether this is going to be an increasing upward trend or just flattening similar to what the industry sees. So we're a bit concerned there, but cautiously not 100% certain of what's going to happen in the future. With regards to severity, our data has been very volatile. We've seen a lot of big spikes in different accident years as a result of various different court decisions. However, then due to the volatility and the long-term nature of the claims, sometimes we do see also a bit of a decrease. So for ourselves, we saw a big jump after 2008, and then the data gets increasingly volatile. So for myself, after reviewing the industry data, I would lean more towards accepting the Oliver Wyman trends as being a better picture of what we might expect going forward, just given the fact that on a more small, volatile book, it's harder to make a judgment. As for the shorter tail coverages, our data generally lies very much in line with what the industry is seeing. Specifically, I was very happy to see that the analysis indicated a higher future trend for collision. That's a very short tail coverage, so it's much easier to make a determination on the trend for that coverage, and we have seen continuously increasing frequency and severity in collision over the past few years. So overall, I think that the trends that have been put forth are very reasonable. I do know that there has been a significant court decision in 2015, the McLean decision, that would not have been incorporated in the industry data from the end of 2014, and it's hard to know how this will unravel as time progresses. So if things do deteriorate as a result of that decision, the trends could be underestimated, but at this point in time, it's pretty hard to say whether that is the case or not.
Okay, great. Thanks, Kristen. We can flip to the next slide after this, and it's just a bit of a graphic, and then we'll go back to a couple of slides with some text on it. What this is getting at is trying to describe, as we look at BI or bodily injury severity, the major factors that contribute to the severity and where we have the data to support each one of the boxes. We've shown it sort of graphically as on the one hand, the erosion of the minor injury definition, which I'll talk about first, and then combined with that and contributing to that, what we've seen in terms of dramatic increase in legal representation for insureds, psychological injuries, and the two court decisions that uphold the TMJ and chronic pain, both injuries, I would say, contributing to those things that move outside of minor injury that perhaps wouldn't have been there had they not had those court decisions. So if we can move to the next slide, turning to the erosion of minor injury. As I just said, two recent court decisions, and Kristen referred, of course, to the recent McLean decision from February of this year, whereby an apparent interpretation of that case has led many plaintiffs to take a position whereby chronic pain would be defined, a soft tissue injury defined as chronic pain, if it's been with a plaintiff for 6 months or longer, and you'll see in a couple of minutes there's a fair amount of compelling statistics in what we've seen in our own data on that. The stats that we've shown in this slide over sort of reaching all of it, if we look back almost a decade, almost 85%, 83 in fact, percent of all of our claims were settled within the MI definition. It's moved down 4 points, which doesn't sound like a lot, and particularly when it's a large company and there's sort of the large law of numbers and a lot of zeros. You look at that and think, what's 4 points? But as you work down the slide in front of you, you see, in fact, that it's quite significant. And for us, what that means is for every 1 percentage point, it's about $650,000 per year. So when you take that and multiply it by the 4, we're in excess of $2.5 million annually. So those are just the financial numbers to give you the sense of the magnitude. But what's really interesting in the middle of the slide is what we've talked about is the average size of the claim. And so for those that are within the minor injury definition, just under the $5,000 mark, about $4,600, and a non-minor injury claim coming in at $90,000. So a fairly dramatic difference in the size of the claim, when there's legal representation involved and when they fall outside of the MI definition. We'll move on to the next slide, please. I mentioned a minute ago the impact of the legal representation, and we've got on this page just an example of some of the things that we've seen in the press. I commented on this dramatic increase in representation by plaintiff counsel, and you can see there the statistics that we have, again, from our data, going back a decade, as low as 4% of our claimants that had a bodily injury were represented, to a spike in 2010 of over 40% of those claimants coming to us with with legal representation, and it's now leveled off just under 30%, but clearly a spike and clearly a fair amount of consumer awareness going on, whether it's in the print media or online media. There's certainly greater awareness from the legal community to seek out some of these plaintiffs. Of course, we've had those two decisions that have been referred to earlier, the 2012 Sparrow Hawk, and then more recently in 2015, the McLean decision, and those tend to be the types of things that attract more people and are things that are, I guess, speaking points, I would suggest, for some of the legal community to use in enticing plaintiffs to come and speak with them. The last bullet on that page also has a fairly compelling statistic based on the experience and the data that we have, and that's that the severity that we see is 2 to 3 times higher on those claims with legal representation. So again, we're seeing a very dramatic increase in the dollars that are attached once there's legal representation involved. And I would also say that the costs are not, and the dollars that are spent are not dollars that are necessarily going to the insured or the plaintiff, but in fact are going to the cost of the system and of taking those steps. The next slide we'll turn to refers to the impact that we've seen from psychological injuries, and in particular, increase in the frequency of psychologically sequelae arising from soft tissue injuries. And so what we're getting at here is, those claims that move outside of MI, the MI definition, the number one reason that they are moved out of that definition is because of psychological sequelae. And so when we look at that, we try to dig a little deeper and understand what's really, what are really the psychological issues, what's there. And what we've found is, in the third bullet we've concluded here, that even those claims that are removed and taken outside of the minor injury definition are done so even if the impact of the psychological injury or harm is quite minor. And so that's an interesting statistic, and it appears that the psychological aspect is one of those things that is being used to take those claims outside of the MI definition. Again, coming to, on the right-hand side of the slide, coming to our own experience and our own statistics prior to 2012, these psychological sequelae present 13%, only 13%. After 2012, we have seen a dramatic increase there to 23% of our claims. So again, we're seeing increased recognition and increased activity, and from the legal community point of view, more of I guess a segue towards using that as the main cause to move an injury outside of the MI definition. Turn to the next slide, please. The Sparrowhawk decision we referred to earlier, and you're all, I'm sure, well aware of that from several years now. It is interesting, as we've now had several years to study the impact of that court decision. The second bullet point on that page on the left is the one that is the most compelling. 50% of claims come in with allegations of TMJ injury. What happens with that, though, is that after a period of investigation, et cetera, we find that there's only about 2.5% additionally that we've actually compensated for that injury. So we're seeing a lot of claims come in with the allegation, and in fact, the substantive work and the discovery process, et cetera, proves, in fact, that those are not appropriate to be captured in that category, and so the final payments and the compensation are made appropriately where those claims are appropriately substantiated, and those are only about 2.5% more than what we were paying before that decision. We're certainly seeing lots of allegations of that type of injury that we didn't see before this court decision in 2012. Next slide, please. Kristen referred earlier to the McLean decision released in February of this year. I commented a little bit on it also in my remarks earlier. At Aviva, we have looked at this and looked at the plaintiff's bar interpretation, and we do not believe it is correct in the facts of the law. So from a sort of technical legal perspective, our team would say this is not the right interpretation. It's clear from sort of a layman's term as you look at the description we've provided here, anyone who suffered from this soft tissue type injury for more than 6 months may be considered to have chronic pain. That we think has taken a very liberal interpretation of what chronic pain is. And clearly, until and unless we have an appeal of that decision or a subsequent court decision, we will find ourselves in a period in a land of uncertainty, which again, as I referred to and Kristen referred to earlier, is something that we think may cause some underestimation in the Oliver Wyman report, simply because there is that uncertainty and the court decision rendering is still quite new and quite fresh. And so we'll live in that period of uncertainty. We will likely have many more plaintiffs associate with that interpretation, try that interpretation, and it will drive up the costs of defense rather considerably. Next slide, we're almost at the end here. This slide was really just a summarization of some of the things we've talked about and a little bit about our position and what we do at Aviva. I mean, as I've described before, there are the court decisions and there are some other factors, but there's clearly the impact of the legal representation, which has had what we would consider or call a multiplier effect on what we're seeing in the base claims. Within our organization, we have a very strong team, a team that's there to make sure that we pay appropriate claims and claims where we should have the appropriate coverage. And so we do that, and we do that with all of the right sort of moral and ethical background that we should absolutely have for that team. But we will also aggressively defend those cases where we firmly believe that someone has misused the definition or is using an injury liberally to take someone out of the MI definition. Our last bullet is, I guess, potentially a plea. The plea here in our presentation that we have support from the government in particular, and then more broadly, we would offer to work with the regulator, the government, and any other stakeholders to make sure that we have the right definition and that it fits for the injuries, because that's what we're here for. We're here to pay the appropriate amount, the right amount in claims when someone is injured. There's no question about that, but we clearly don't want to see that being misused. And so our plea here is to make sure that we have the appropriate definition, minor injury definition, to make sure that we have considered and captured all of the right injuries. Last sort of housekeeping slide, I think we were asked to comment on the treatment of EULA. It's a fairly short slide here. We believe it's reasonable to have EULA included in the data underlying the trend analysis. Clearly it helps avoid any bias that you may have between the companies. And my very last slide in concluding remarks, it's very clear from us and the data we've seen and what you've seen from the Oliver Wyman study that BI costs are increasing. It's very clear to us that BI is primarily the driver in the increased claim costs that we have seen over the last few years. The uncertainty related to the McLean decision can be significant. We've only had it for 6 months or thereabouts. And as I said earlier, unless and until we have another decision or an appeal, we will live with that uncertainty and continue to face higher defense costs as we appropriately have a different position than plaintiffs on that interpretation. I've just said a minute ago that a government action is needed. I also said that we are absolutely committed to working with the government here, the superintendent, his office, any other stakeholders we need to make sure that we have the right definition for MI, to make sure that we pay fair and appropriate claims. And lastly, of course, our mission here in Alberta, where we have a strong showing in our business, is that we maintain that share, we maintain a good showing with our customers in Alberta, and that our auto insurance remains accessible and affordable to all Albertans. That concludes my remarks. Thank you.
Thank you very much for your presentation. I'm going to ask the board if they have any questions for Aviva. Chris?
If I can go back to slide 6, I think it is. And then flip after that to slide 8. So when you talk about BI severity, and then you talk about the second bullet, the legal representation. Now if I could flip to slide 8. Okay, you talk about the 2010 claims cost from legal representation at 41%, and then leveling off now at 27%.
So those are claimants that are represented by counsel?
Right. So what do you attribute the leveling off from the 41% to the 27%?
It's a good question. We're still analyzing that. We did some work around 2010 because of what we saw sort of in marketing materials and sort of more consumer awareness, and we're still trying to compare and contrast the level of that to what's done now. So is it simply more awareness from customers, consumers? We haven't concluded that that's the only thing, but it may be a contributing factor. So it's one of the things that we think may have driven it, is just more people being aware and looking for it. There's also, when we stepped back and looked at the larger macroeconomic environment, so for purposes of this discussion and a broader discussion in insurance generally, there was a period of time post-financial crisis where there were many consumers or customers who were looking for different avenues for compensation. And so it translates here in a broader sense in the insurance industry, in the life insurance industry. It translated into larger and longer disability claims and some other things. So after post-financial crisis, as things sort of unwound, people found themselves in a different position. So I think those are two of the things that we have investigated, and there's still a few more, but clearly 2010 was a different period for a lot of reasons.
So not to put words in your mouth, but you wouldn't see a leveling off necessarily of BI claims in that area?
A
leveling off or a downward trend in that area?
I wouldn't.
As we move forward.
I wouldn't. No. Now, given I just said there's 6 months since the McLean decision, I think there's more to come. I think as that interpretation is used more broadly and more people are aware of it, I think that will start to reignite the 27%, and it could likely go higher very soon.
Thank you.
Okay.
Any other questions from the board?
I might have a comment.
Sure.
I'm just having trouble with your logic. So in 2010, 41% of claimants have counsel. It's now dropped by a third in 5 years. The spike was prior to the Sparrowhawk decision, which we have to agree is a judicial decision, not a plaintiff's argument or a plaintiff's lawyer's argument.
Mm-hmm.
It's prior to the McLean decision, but what I'm getting from your capturing of ads up here is that this is a lawyer-driven problem, but it doesn't seem to me that statistically, other than your last point, which is when people retain counsel, they, for the most part, have more serious claims and receive more money, as to how your explanation ties together.
So my anchor would be going back to the first sub-bullet, which shows what it looked like from 2005 to 2008, when it was a very different level, and particularly when you look, I mean, I can't remember exactly what each of those years were. I don't think it was a linear increase. But when I think about, if I could use 2005 as my anchor, at 4%, I have a very different result now. If I even picked it at 10% or 15%, I still have a very different result today. So I'm not anchoring at all on 2010, where we just described there could be other factors, more macroeconomic factors, and not driven by Sparrowhawk because it predated Sparrowhawk. But there are a number of things that we can, sort of pick at, but we still see a dramatic increase over the period of time. And the sampling of what you would see is something that we've seen here, and we've seen in other environments where that causes a sustained increase over time when you have more awareness and solicitation.
I'd be really interested to see where you got your 4% number 10 years ago. I guess the second point of my commentary was that if we're suggesting that all of this is plaintiff lawyer driven, doesn't that ignore that Sparrowhawk and McLean are judicial decisions?
So I didn't suggest it was all driven. The chart that we set out before this page was suggesting there were a number of contributing factors. So there was if we could flip back, there was the MI, the sort of creeping of the MI definition on the left, and then a number of things, sort of as the right, and arrows or whatever were to sort of thread them together. So I'm not suggesting it's solely, I'm suggesting that it's a contributing factor.
Thanks.
Any other questions? Chris?
Just maybe I can change topic slightly.
Sure.
In my presentation, which you unfortunately missed, but that's okay. You're forgiven.
I'm sorry. Circumstances beyond our control.
The words that I got back from consumers on our consumer survey this year were two sort of key phrases that resonated with me, which was transparency and ability to control your own premiums. So, in essence, discounts. Okay? And one of the things that a focus group zoned in on was UBI as one, and other discounts that insureds could control themselves, like UBI again. Mm-hmm. So, not asking for specifics, but have you, as a company, given any consideration to, first of all, transparency that would allow policyholders to see where their discounts and some of it, how their policy is made up, or how their premium is made up, excuse me. Because in this world today, we are far more complex in our rating philosophies and how we rate. So it becomes more and more difficult for an insured to see how their premium is made up. So number one, is there an area that you could be more transparent to the consumer? My second question is not to get into specifics, but is there areas of discounts that you're looking at that would make the insureds more control or be in control of their own destiny and their own premiums?
Mm-hmm. So I'll answer your question broadly within Aviva, as we have a large foreign-based parent company that has been almost a leader, I would say, in usage-based insurance. So beyond just telematics and UBI itself, but truly usage-based, where a customer can look and see exactly how much I would pay if I took a trip. And so that's very different style. And so that thinking and that environment outside of Canada is very different to what we live in here today. But it is something that we are tracking very closely in Canada because, like you, where you see or getting sort of customers and consumers' desires, we get the same feedback around misunderstanding about sort of a bulk payment amount for something that may not be used for a period of time, whether that's because of a person's lifestyle or situation, etc. And so we clearly are looking at that and looking at it with the lens of a foreign parent in a different environment, where it is, I would say, more customer-driven. And so there's lots of ideas that we have about how we can accomplish that. I'll leave the specifics aside, but lots of ideas on how we can accomplish that. And we would certainly look forward to being able to operate on that basis across the country, because we think that that's where consumers are going.
Thank you. Well, I believe that concludes this session, part of the session. So thank you very much. We appreciate you making the presentation to the board. I'm going to, you can stay there if you like, because we're just going to do some concluding remarks here.
Perfect.
So I'd like to say, on behalf of the AIRB board, I would like to thank all those who presented and provided written submissions to the board today. The board will be taking all the information that was presented today in consideration as it deliberates in the setting of industry benchmarks, which will be used to our review of insurance rate filings effective October 1st, 2015. All of today's presentations will be posted on our website at arb.alberta.ca this evening and will be available for viewing. A recording of today's presentation will also be available on our website no later than August 28th, 2015. Following today's meeting, the board will consult with our actuary, Oliver Weidman, to determine any additional information that may be required to finalize our 2015 annual review report, which must be posted on our website no later than September 30th, 2015. In addition, the information gathered today will also assist the board in setting grid entry-level rates effective January 1st, 2016. The grid establishes a maximum premium for basic coverage for all driver profiles. It protects drivers from rates that may make insuring a vehicle prohibitive. Again, I would like to thank each of the participants for assisting us in gathering information and data to support our decision, and I hereby call the meeting closed. Thank you very much. Okay.